Hello friends, hello students. So today we are discussing the revision of assessment of various entities. So what happens, as you guys know, the income tax has a definition of the word person, and person includes a lot of different entities. As you know, company, individual, HUF, AOP, public BOI, partnership firm, including LLP, cooperative society, local authority, etc. So this chapter deals with the assessment, the provisions which are applicable specific to an entity, say for a company, for an individual, etc., etc. Okay. So in today's class, in today's revision, we'll cover the provisions applicable to the company and provisions applicable to the firm. We will cover taxation of company and taxation of firm. Okay. So to start with, what is a company? So my Income Tax Act defines a company. Company means an Indian company. Now, what is an Indian company? We'll come to that. An Indian company, a foreign company. Yes. Even a body corporate incorporated outside India under the laws of a country outside India is also a company for the purpose of Income Tax Act. So company includes an Indian company, a foreign company, and any association, institution, or body. Yeah. Even if the entity is not incorporated as a company, it's incorporated as an association, institution, or body, then still it can be a company if it was assessable or is assessed as a company, or is declared by the CBDT to be a company by a special order. And when a CBDT issues an order, it also specifies the years for which such association, institution, or the body, as the case may be, shall be treated as a company. So company may be Indian company, foreign company, or any association, institution, or body which is or was assessable as a company, or which is declared by the CBDT to be a company for specified years. Okay. Then what are the different classes of the company? So company can be classified either as a domestic company or a foreign company. Now, within the what is a foreign company? Foreign company is nothing which is not a domestic company. Actually, it means a company or body corporate which is incorporated by or under laws out of a country outside India. It means a company which is incorporated outside India under the laws of a country outside India. Okay. Domestic company. So domestic company, who is a domestic company? Domestic company, an Indian company is a domestic company, or any other company. Any other company means another other than Indian company, any other company which has made which has income liable to tax in India and has made prescribed arrangement for declaration of dividend out of such income. So domestic company includes Indian company or any other company which in respect of its income liable to tax has made prescribed arrangement for the declaration and payment of dividend within India payable out of such income. So either you are an Indian company, then you are a domestic company, or if you're not an Indian company, then you have an income liable to tax in India, and you have made prescribed arrangement for declaration of dividend within India out of such income. What do you mean by prescribed arrangement? Prescribed arrangement includes three things. One, the register of shareholders, the share register should be in India. Second, the general meeting in which these accounts are finalized and dividend declared should happen in India. And thirdly, the dividend is payable within India to all the shareholders. Okay. Now, what do you mean by Indian company? Firstly, Indian company means only those entities will be treated as Indian company which have their registered office or principal office within India. So this is mandatory. So all these entities, 1, 2, and 3, they are classified as Indian company. They are treated as Indian company only if they have their registered office or principal office in India. So first category is the company which is formed and registered under the Indian Companies Act, means either Indian Companies Act 1956 or Companies Act 2013. So if it is a company which is registered or incorporated under the Indian Companies Act, then Indian company, provided it has a registered office and principal place in India. Or corporation established by or under Central State Provincial Act, such as Financial Corporation, State Road Transport Corporation. Okay, these are also treated as Indian company. And lastly, any institution, association, or body which is declared by the board to be a company, is declared by the CBDT to be a company, which is also an Indian company. So we discussed what we understand by the meaning of the word company. Company includes Indian company. And now we are discussing the meaning of the Indian company. All these Indian companies are also treated as a domestic company. Okay. Now, there's also one category. A domestic company can further be divided into a closely held company or a widely held company. This category, closely held or widely held, is applicable only to a domestic companies. Okay. So, closely held company means a company in which public is not substantially interested. Widely held company means a company in which public is substantially interested. So as a layman, what we understand by the word widely held company? Firstly, means a company whose shares are listed on recognized stock exchange as on last day of the previous year. But it also includes a company, the 50% of the voting power of which is held either by the government or statutory corporation or another company which is widely held company or its subsidiary. Means either it is itself listed or even a subsidiary of a listed entity is also treated as a widely held company, or subsidiary of a subsidiary of a listed entity is also treated as a widely held company. Or if at least 40% of its shares are either jointly or severally held by government, state government or central government, or RBI, or any corporation owned by the RBI, then also such company shall be treated as a widely held company. Section 25 or Section 8 companies also treated as widely held company. Company not having any share capital, which is declared by the board to be a company in which public is substantially interested. So they are specifically treated as a widely held company. Then mutual benefit finance companies are treated as widely held company. And lastly, if 50% or more of the equity share of the company are held by one or more cooperative society throughout the previous year, then such company is treated as a widely held company. Okay. See, if we were talking about whether shares of the company are listed or not, then we were seeing the shares should be listed as on last day of the relevant previous year. But if you're treating it as a widely held company because its shares are held by cooperative society, then such shares should be held throughout the relevant previous year. Okay. These are some final points. Now, why we are discussing this? Different types of the company. Because tax treatment differ as per the category of the company. For domestic company, there are different tax rates, For a foreign company, there are different tax rates. We will study in a minute. There are some advantages which are provided to domestic company, which is not available to the foreign company. Okay. Similarly, there are some provisions which are applicable only to the closely held company, which are not applicable on widely held company. So, these restrictions, these compliances are to be made only by the closely held company. One of such closely held company means the company in which public is not substantially interested. In a layman term, we understand company which is not a listed company. Okay. So what are those provisions? One is deemed dividend under Section 222E. So if a widely held company gives a loan to its shareholder, no deemed dividend provisions attract. But if a closely held company gives a loan to its shareholder, deemed dividend provisions attract. Okay. The loan is treated as dividend in the hand of shareholders. Then Section 68. Taxation of sum received by a closely held company at share application, money or share capital, share premium, and explanation offered by the company is not satisfactory. So if you are a closely held company and you have received some share application money or share capital from some person, you are required to explain the source of such application money or share capital. But if you're a widely held company, such provision is not applicable. You're not required to demonstrate the source. Okay. Section 79. Carry forward set off or loss in case of closely held company. If there's a change in shareholding, then the section 79 restricts the carry forward some losses. But such provision is applicable only in case of closely held company. Then section 179, the liability of a director in case of a closely held company. So these are some of the provisions which are applicable only in respect of closely held company. They are not applicable for the companies in which public are substantially interested. Okay. So this is the reason we are required to understand the meaning of this. The term we understand to examine whether company falls under the category of closely held or widely held, because my tax provisions will differ as per the classification. Now, tax rates applicable to the company. Now here, as I told you, here the fact that whether you're a domestic company or a foreign company makes a difference. So for a domestic company, what's the tax rate? We are discussing tax rate for FY 25-26. So for FY 25-26, if the turnover of such domestic company in the PY 23-24 was 400 crore or less, then the tax rate applicable to it was 25%. If the turnover was for more than 400 crore, then the tax rate applicable is 30% for the domestic company. Then if the total income of the domestic company exceeds rupees 1 crore, surcharge is also levied at the rate of 7% of the income tax. And if the total income exceeds 10 crore, then surcharge is levied at the rate of 12%. Okay. Then these were the tax rate for the domestic company. Now tax rate for the foreign company. So foreign companies tax at the rate of 35%. Here also there is a surcharge, but the concessional surcharge. The surcharge rate is 2% if the income exceeds 1 crore and 5% if the income exceeds 10 crore. So for domestic it was 7 and 12. Sorry. And for foreign company, it's a 2% or 5%. So this was the tax rate applicable in the old regime. For the companies also, there are two types of regime, old regime and the new regime. Okay. So we discuss the tax rate only as per the old regime. Now, the new regime. Okay. So under new regime, there are concessional tax rate, but of course, some exemption deductions are not allowed. So what happens under the new regime? The total income exceeds because of a restriction on the exemption and deduction, but the tax rate is concessional so as to compensate the excess total income. Okay. So one benefit is provided to a new manufacturing companies or new company which are engaged in generation of electricity under section 115 BAB. So what does 115 BAB say? It says if you are a company incorporated on or after 1st October 2019 and you have commenced the manufacturing of any article or thing or generation of electricity on or before 31st March 2024. So the period during which this 115 BAB was applicable is company must be incorporated on or after 1st October 19 and must commence operation, manufacturing or electricity generation on or before 31st March 24 between this period. So if you are a company which falls under this provision within this period and satisfies the condition, which we'll discuss in a minute, then the income from such manufacturing or electricity generation shall be taxable at a rate of 15%. Such a concession, such a benefit. Earlier, the company is taxable at the rate of 25% or 30%, as we just saw in the old regime. But if you're a manufacturing company incorporated on or after 1 October 19 and commence operations, which operation? Manufacturing or electricity generation on or before 31st March 24, then the tax rate applicable on such income is 15%. In this case, the surcharge of 10% applicable irrespective of the income. So it's a mandated surcharge, whether your income is less than 1 crore, still 10% surcharge is applicable. If we opt for 115 BAB, then MAT provisions are not applicable. And okay, so it's applicable. The SSC who's eligible for 115 BAB is a domestic manufacturing company, electricity generation company. So you see, here only domestic companies are allowed, yeah, not the foreign companies. For this beneficial provisions. Manner of computation total income. Income derived from or incidental to manufacturing or production of article or thing or generation of electricity. So if you're deriving income from these operations from manufacturing or from electricity generation, as the case may be, then such income is taxable at the rate of 15%. But if you have any other income on which no special rate is given, then that other income is taxable on gross basis at the rate of 20%. Of course, increased by surcharge of 10% and cess of 4%. If there is short-term capital gain on transfer of asset on which no depreciation was claimed, then such short-term capital gain is also taxable at the 22%. And any special rate of income like 112, 112A, 111A shall be taxable at the rate applicable to such income in the chapter 12. Okay, so understood? So the 15% concessional rate is given only in respect of income from such manufacturing operation from the operation of generation of electricity. The other incomes are taxable at 22%. And if there is a specific rate, special rate applicable or any special income, then such special income shall be taxable at such special rate. Okay. What is the eligibility condition? As I told you, the company, I need a new company. So company is set up and registered on or after 1st October 19. Company must be engaged in business of manufacture, production of an article or thing, and research in relation to a distribution of such article or thing, or business of generating electricity. So benefit is given to manufacturing entities or to electricity generating entities. Such manufacture production must commence before 1st April 2024, that is on or before 31st March 2024 is a sunset. If the manufacturing is commenced after such date, then you have missed the train. This benefit is not applicable. Of course, as we study, whenever there is concession, then it gives levies a condition that the entity is not formed by splitting up and the entity is not formed by transferring old machine, and the 20% of old machines are allowed. So company does not, another condition is that company does not use a building or hotel previously used as a hotel in respect of a deduction of section 80 ID was allowed. So it should not use a building which was previously used as a hotel and deduction of section 80 ID was allowed. So these are the conditions. What are the conditions? Incorporated on or after 1st October 19, commenced operation, manufacturing or electricity generation before 31st March 2024, on or before 31st March 2024, not formed by splitting or from transfer of old asset, and is not does not use any building which was earlier used as a hotel or convention center under section 80 IT. Okay. Income is computed without allowing some exemption reduction, which we will discuss in a minute. This optional section 115 BAB has to be exercised in the first year when the company is required to furnish return, when the company commences its operation. If such option is not exercised in the first year, then this option cannot be exercised under section 115 BAB. Then you will have to pay the tax under the normal provisions. Okay, which we will discuss. There are two regimes under normal provision as well. The old regime, which we already discussed, 25%, 30%. This is a new regime, section 115 BAA, 22%, which we'll discuss in a minute. This option, once exercised, cannot be withdrawn. Okay. Also, if there's a transaction between this company and any other associated company, maybe the domestic company, and such transaction is not at arm's length, then specified domestic transfer pricing shall be applicable, and any excess profit computed by the AO, tax officer, on account of this applicability of transfer pricing, then such excess profits shall be taxable at 30%. Okay. So this was a benefit given to a new manufacturing company which commence operation on or before 31st March 2024. Okay. This is a new regime. The old regime was 25%, 30% case of domestic company. The new regime is given in section 115BAA, which provides a concessional tax of 22%. It's applicable to any domestic company, old, new, manufacturing, non-manufacturing, service, whatever. It's applicable to all domestic company, and the concessional tax is 22%. But again, similar to the 105BAB, there's a mandatory surcharge of 10%, irrespective of the amount of the income. So even if the income is less than 1 crore, less than 10 crore, whatever it may be, there's a surcharge of 10%. MAT doesn't apply even in case of 115BAA. So if there's any brought forward MAT credit, once you opt for 115BAA, any brought forward MAT credit, yes. Okay, you cannot take it forward. Well, tax rate 22%. But if there is any special income in respect of which any special rate of tax is provided under the Act, then such income shall be taxed at such special rate, similar to 115BAB, say 112, section 112, 112A, etc. Okay. See, there's a difference between 115BAB and 115BAA is that under 115BAB, the concession rate is given only in respect of income from manufacturing or electricity generation. But for 115BAA, the concession 22% given for the all income. Of course, except the special income, only special rates provided. The computation of income is similar. Whatever exemption deduction is not available in section 115BAB, similar exemption deduction not available for 115BAA. Okay. This option has to be exercised on or before the due date of furnishing return of income under section 139(1). And option 1 exercise shall apply to subsequent year. So you have to exercise only of one. You need not to exercise every year. Okay. But option 1 is once exercise cannot be withdrawn subsequently. Now how the income is computed for both the purposes. 115BAB, the 15% company, and the 22%, 115BAA. So total income is computed without giving effect to the following. Means these following deductions or exemptions are not allowed. Section 10AA, SCZ, additional appreciation and 33ABA. Then scientific donations given to any research association or a company or national laboratory, university, IIT, or any expenditure in respect of in-house research and development. So this section 35, this amount paid to outside entities or in respect of in-house research is not allowed. Then section 35AD, 35 35 CCD. Then deduction of chapter 6 says are not allowed except the 3 deductions. What are these? 80JJAA, 80LA in respect of IFSC, and 80M in respect of intercorporate dividend. So other than these 3 deductions, no other deductions are allowed in chapter 6A. Any set of brought forward loss, of early brought forward loss, which is attributable deduction that we just discussed, such set off shall not be allowed and shall be deemed that such loss has been lapsed, has been utilized. It shall be deemed that full effect has been given to such loss for depreciation. Total income is computed by claiming depreciation in the section 32, except the additional depreciation determined such manner as may prescribe. In such manner means the maximum depreciation rate allowed is 40%. Okay. These 5 business are not treated as a business manufacture, production of article or a thing. Meaning thereby, if the company is engaged in these 5 business, any of these 5 business, it will not be eligible for a concessional tax of 15% under section 115BAB. Okay. So what are these business? Business of development computer software, or mining, or conversion of marble block into slabs, or bottling of gas into cylinder, and lastly, printing of books or production of film. So these 5 business are not considered as manufacturing. So it avoids the litigation. So there is no litigation. The Act specifically provides the benefit is not given to these 5 type of companies. Okay. Or any other business notified by the central government. Okay. As you know, 115BAB is to be claimed in the first year. But there happens a case, say there's a company which was claiming 115 BAB, and now it has been amalgamated to another company. Now the another company can also claim 115 BAB, provided it satisfies the condition. However, the losses of the amalgamating company, which was attributable to deduction not allowed, shall not be allowed to the amalgamated company under section 72A, and shall be deemed that full effect has been given to such losses. Okay. See, 115 BAB gives a sunset clause in respect of commencing of manufacturing operation or electricity generation, which is 31st March 2024. But if you are a company which has commenced this operation before this date, and you have claim you claim you opt for 115 BAB, then 115 BAB is applicable even now. It will keep on be applicable on you. Well, if you have availed it at once. Okay. If you earlier were eligible for 115 BAB, you will continue to be eligible unless you default. So this was about the tax rates applicable to the companies. So there's an old regime in which taxes are given for domestic and new foreign company. Domestic 25% if turnover was up to 400 crore, and 30% turnover exceeds 400 crore. And for the foreign companies, it's 35%. There's surcharge of 7%, 12% as the case may be for domestic, and 2%, 5% as the case may be for foreign. These are normal. But for domestic companies, there's a new regime which is applicable. They can opt for new regime under 115BAA for a concessional tax of 22%. In such case, they will not be allowed some exemption deduction, like deduction chapter 6A, except 80JJAA, ATM, and ATLA, or section 10AA SEZ deduction. Then some scientific donations and 32, 35 AD, 35 triple C, 35 double CB. All these exemption deductions are not allowed. But the tax rate is concessional, 22%. But in this case, there is a mandatory surcharge of 10%. Remember. Also, the special income shall continue to be taxable at a special rate provided for such income. Okay. Now here comes a special incentive for the new manufacturing entity, which set up on or after 1st October 2019 and started the manufacturing on or before 31st March 2024. If they are engaged in the manufacturing or production of article or thing or generation of electricity, then they can opt for 15%. But the 5 activities which shall not be considered manufacturing are development of computer software, mining, conversion of marble into slabs, bottling of gas into cylinder, and lastly, printing of books or production of film. Okay, so these entities are not eligible for the concessional tax of 15%. They can apply for 22% under section 115BAA. Option to opt for 115BAB has to be exercised in the first year of operation. Okay. So this was all about the tax rate. Now we'll discuss the MAT, minimum alternate tax. This is applicable only to the companies. Only domestic company? No. MAT is applicable to both domestic company as well as to the foreign company. So what it says, firstly it says that every company shall prepare its profit and loss account in accordance with the provisions of Companies Act 2030. However, there are some companies which are governed by a special statute, and such statute only provides the manner of preparation of profit and loss account of financial statements of such entities. So such entities shall be required to prepare P&L account as per the provision of their special statute. Which are these entities? Entities engaged in insurance business, banking business, or electricity companies. So there are special statutes governing these entities which prescribe the manner of preparation of final accounts. So these entities are required to prepare accounts in accordance with the provisions of such special statutes. Now, section 115JB says that while preparing profit and loss account, the accounting policies, the accounting standards, and the method and rate of applying the depreciation shall remain same. So while preparing profit and loss account for the purpose of section 115JB, for the purpose of computation book profit, the accounting policies, accounting standard, and the method and rate of depreciation shall be same as adopted by the company for its AGM, for presenting its books of account, for presenting its profit and loss account in the AGM. Okay. So what it says? It says if the normal tax payable by the company is less than 15% of the book profit, then the book profit shall be deemed to be the total income of the company, and the tax on such book profit shall be the 15%. However, if in respect of unit located in IFSC and deriving income in foreign convertible exchange, the MAT rate applicable to such unit is 9% instead of 15%. Okay. So what does we do in MAT? We compare the normal tax with the 15% of book profit. If the 15% book profit is higher than the normal tax, then we are required the book profit shall be deemed as a total income, and the 15% on such book profit is the tax payable by the company. Of course, the applicable surcharge and cess is also levied. Okay. How the book profits are computed? So, computation book profit section 105J. So it starts with the net profit as a profit and loss account. Profit and loss account is prepared in accordance with the Provision of Companies Act, Schedule 2, and the accounting policies, accounting standards, method and rate of appreciation used for preparing this P&L. Preparing the P&L for the purpose of section 105JAB, for the purpose of section 105JB are same. These policy standards and method and rates are same as adopted by the company for presenting the account in the AGM. Okay. Now, the net profit which is computed as per the P&L account is added by the amount of income tax, of course, or any provision thereof, or deferred tax, as the case may be. Okay, or both. It may have both. But then amount carried to any reserve, amount taken to any reserve below the line item is also added. Then provision for meeting uncertain liabilities. So provisions are by itself not disallowed. Only provision related to uncertain liabilities. They are in the nature of reserves. So they are disallowed. You have to add back. Provision for loss of subsidiary company is added. Then provision for diminishing in the value of any asset is added. Okay. Then there's a dividend is added, whether paid or proposed. The depreciation as per books of account, whichever debited in the P&L account is added, and amount standing in the revaluation reserve in respect of asset which has been transferred or discarded. So if there is any asset which has been transferred during the year, and if there is any amount standing in the revaluation reserve in respect of such asset, then such amount shall also be added, even if not debited to the profit and loss account. Okay. Now, some income is not subject to MAT. So any expenditure in respect of such income is also added. It shall not be allowed. So one such any income referred to in section 10 or 11 or 12. So amount of expenditure relatable to such income, which income referred to section 10, amount of expenditure relatable to income being share of assessee in the income of AOP or BOI, on which no income tax is payable under section 86. Means if the AOP has paid tax on such income at MMR, then the member is not required to pay tax. And if any expenditure is debited in the P&L account in respect of such income, then such expenditure shall not be allowed as deduction. It has to be added back while computing the book profit. And in the when we'll discuss what all items are to be reduced, there you will see that these incomes are reduced. Okay. So net effect, neither the income is treated, this tax is included in the book profit, not related expenditure. So what are these income? Income under section 10, 11, 12, or share of member in the AOP or POI. Inspector of foreign company. The amount of expenditure relatable to income accruing to a foreign company from capital gain arising on transaction in securities or interest, dividend, royalty, or FTS, if such income is taxable at a rate less than the 15%. then MAT is not applicable on these income as well if they are taxable in the normal provision at a rate less than 15%. Then any expenditure relatable to the royalties in respect of patent taxable under section 115 BBF. So this royalty is not liable for MAT. So any expenditure in respect of this royalty is also added back. Then what does it say? Last clause. It says if there is a exchange of shares of SPV in consideration of units of business trust, then if there's any gain or loss on such exchange, you have to ignore it for MAT purposes. If there's a gain or loss by changing the carrying amount of said units, you have to ignore that. On transfer of such units, if there's a gain or loss debited or credited to the P&L account, you have to ignore that, and you have to add or less the actual gain or loss on transfer of such unit, taking into account the actual cost of the shares. Okay. So what this is, all notional income or losses are ignored on the actual gain or loss arising to the person on transfer of the units of business trust by treating the cost, the original cost of shares as a cost, only shall be allowed. So fair enough. So what does we discuss? The book profit is to be increased by, of course, you understand, by the income tax or the deferred tax. Then there is a reserve or provision for an uncertain liability. Then there are three types of provisions. Provision for uncertain liability, provision for loss of subsidiary, and provision for diminution in the value of the asset. Then in dividend declared whether paid or proposed is to be added back below the line item. Then the depreciation amount, which is debited to P&L account, is added back, and any amount standing in the devaluation reserve in respect of asset which has been transferred. So asset has been transferred, but there is amount standing in the revaluation reserve for that asset. Then such amount has to be added back even if such amount has not been debited to the profit and loss account. Okay. Then there are some income which are not liable to MAT, and therefore any expenditure in respect of such income is also added back. What are those incomes? Income under section 10, 11, 12, or share of profit in AOP or BOI, or income of a foreign company, capital gain in respect of transaction in securities, or interest, dividend, royalty, or FTS, which is otherwise taxable under normal provision at a rate less than the 15% rate, less than the MAT rate, and or royalty under section 115 BBS. Okay. Then lastly, what we add is that the notional loss, if any, booked in the profit and loss account in respect of unit of business trust. But if the units are transferred, then the actual gain or actual loss is considered for MAT purposes. Okay. Now we'll see what all amount is to be reduced while computing book profit. So amount withdrawn from reserve, if the same was added in the computation of book profit in the year of creation, if any reserve was created out of P&L account, then any amount withdrawn from such reserve is to be reduced. Depreciation actually debited to the P&L account. So earlier we were adding the depreciation here. Now we are reducing the depreciation. But at the time of reducing, we are not considering depreciation on the revalued amount if there is revaluation. Okay. Amount withdrawn from revaluation reserve to the extent it does not exceed the amount of depreciation on account of revaluation. Okay. Now the income which are not liable to MAT. Earlier we saw the expenditure in respect of these income. Now the act says these income are to be reduced because they are not liable to MAT. What are these income? Income referred to in section 10, 11, or 12. Share of profit, income in AOP or BOI, on which no income tax payable under section 86. The foreign company, the capital gain from transaction in securities, or interest, dividend, royalty, FTS, if such income is taxable at a rate less than the MAT rate of 15%. The royalty in respect of patent and chargeable under section 115 BBA. So these income was not taxable. So these income are reduced, and any relatable expenditure is also added by while computing the book profit. Okay. in respect of business trust, as we discussed, all this notional gain are reduced and only the actual loss, if there is any, on transfer of unit by considering the cost of the shares is to be reduced. Now, other things which are to be reduced are amount of loss brought forward or unabsorbed depreciation, whichever is less as per books of account. So, and the loss shall not include depreciation. So, as a books of account, if there is any brought forward losses, we have to compare such book losses with the book depreciation, whichever is less, the such lesser figure is allowed to be reduced. Nothing should be reduced if either of these figure is a 0. But in case of these two companies, the aggregate of unabsorbed depreciation and loss is allowed to be reduced. Which are these two companies? One company against which insolvency application has been admitted by the IBC, and another company if the company and the subsidiary of subsidiary, where the NCLT on application of central government has suspended the board and has appointed new director nominated by the central government. So if there is any company for which the NCLT has suspended its board of directors hence and appointed the new central government's nominees, or if the company against which insolvency application has been admitted, in such case, the aggregate of depreciation and unabsorbed depreciation and brought forward losses are allowed to be reduced. In all other cases, the brought forward depreciation, unabsorbed depreciation, brought forward business loss, whichever is lower, has to be reduced. If the company is a sick industrial company, then amount of profit of such company from the period on which it became sick and till the previous year by which the net worth becomes equal to or exceeds the accumulated losses. So the sick industrial company is not liable to MAT for during this period. Amount of deferred tax, of course. Okay. So this is the computation of book profit. The book profit we less some item and the book profit is ascertained. Now we apply 15% on this, so we come to a figure of a tax. We compare this tax figure with the tax under the normal provisions. If this 15% is more than the normal provision, then the book profit are treated as total income and this 15% is the tax paid by the company. Okay, we say that MAT is applicable on the company. Company is liable to pay the MAT only when the MAT liability is more than the tax liability in the normal provisions. Okay. Now we know that the Ind AS has been notified. No? So it's not applicable to all companies, but there are conditions. And if a company satisfies such criteria, it's required to maintain its books of account as per Ind AS. Okay. So in case the profit and loss account is prepared as per Ind AS, then there are some more adjustments which are to be made. In such case, there are two types of adjustment. First adjustment is in the year of adoption, in the first year of adoption. So when the company first adopted Ind AS, there is a set of adjustment in such year, and then there continuing adjustment because of Ind AS. Yeah? So there's different accounting prescribed by the Ind AS. So it requires, if the accounts are prepared by Ind AS, there are some other adjustments which are to be made. Yeah. So let's first see the continuing. So if you are Ind AS compliant company, then in addition to the above, which we discussed, you have to do some more adjustments. The book profit as computed above shall be adjusted as under. You have to add amount credited to the OCI, other comprehensive income, under the heading items that will not be reclassified to P&L. So if there is any items under the heading items not to be reclassified to P&L account, such items has to be added by if debited, and reduced if added by if credited, and reduced if debited. See, what does it say? These are the items which are not credited to the profit and loss account, but credited directly to the OCI, and these items will never be classified to the P&L account, even in future. So, company must pay MAT now, because in future it will not come under the P&L account. So it says, if there is any such item which will in the OCI, which will not be reclassified to the P&L account, if any such item is credited to the OCI, such amount has to be added to compute the book profit. If any such amount debited to the OCI, such amount has to be reduced while computing the book profit. Logical enough? Okay. Another adjustment is, if any amount is debited to the profit and loss account on distribution of non-cash asset to shareholders in a demerger, in accordance with Ind AS 10. So Ind AS 10 requires the adjustment on account of distribution of non-cash asset in case of demerger, to the shareholder in case of demerger. So such adjustment is nullified if there is any amount debited in the P&L, it has to be added by. If any amount, such amount is credited to the P&L, then it has to be reduced. So there's only two adjustments. One is any item stated in the OCI and which will not be classified to the P&L account. Such item has to be considered for MAT. So if such an amount is credited to the OCI, it has to be added back. If such amount is debit to the OCI, it has to be reduced. Another item is, if any amount is debited in the P&L account on account of distribution of non-cash asset to the shareholder in demerger, then such debited amount has to be added back. And if such amount is credited, then it has to be reduced while computing the profit. Okay. Even in respect of these two transactions, these two items, no adjustment is to be made if any amount is credited or debited to OCI under the head item that will not be reclassified in respect of. So even if there is an item under the heading item will not be reclassified to P&L, even in such case, no adjustments to be made in computing book profit if such item is related to revaluation surplus of assets. There is a revaluation surplus of assets or gain or loss from investment in equity instrument designated at fair value through OCI. So if there is revaluation surplus or there is any amount on account of fair valuation of equity instrument, so and such amount is there in the OCI, though under the heading items not to be classified in the P&L. Still no adjustments to be made, and adjustments to be made only when this asset or this investment, as the case may be, is actually transferred or sold off. So the above two amount shall be adjusted in the previous year in which asset or investment, as the case may be, has been transferred. So understand? Fair enough? So no notional gain or loss, no MAT on notional gain or loss, only when the asset is actually transferred. Whatever the gain or loss happens, we will charge MAT only on that. So taxation very clear. We will not charge the unrealized profit or loss. Okay. Now, in case of resulting company, in case of demerger, the resulting company, where the assets and liabilities of the undertaking received by it are recorded at a value different from the values appearing in the books of accounts of the demerged company immediately before the demerger, of course. Any change in such value shall be ignored for the purpose of computation book profit of the resulting company. So the demerger and the resulting company has changed the value of the asset received by it of the undertaking, then any adjustment because of such change shall not be liable for MAT. So this was the continuing adjustment. Okay. In respect of India's companies, only two things. Any amount stated in the OCI which will not be reclassified to P&L, such amount is to be treated for MAT purposes, and any adjustment on account of distribution of non-cash asset to shareholder and demerger has to be ignored. Even in case of OCI, these two items are not considered. What? One, revaluation surplus, or amount on account of adjustment to the fair value of the equity instrument. These two items shall be considered only in the year in which they are actually transferred. Okay. Now, if this is a first year adoption, so what happens? Book profit of the year of conversion. So there is a transition amount in the year of, if there is a first year of conversion. This transition amount is allowed in 5 years, equal installment. First year and 4 subsequent years. First year means the year of convergence and the 4 subsequent years. So book profit of the year of convergence and each of the 4 previous years shall further be adjusted by 1/5 of the transition amount. So whatever the transition amount is, we'll discuss how we come to transition amount. Whatever the transition amount is, such transition amount is adjusted in 5 years in equal installment. Okay. Now, what is transition amount? Transition amount means the amount adjusted in other equity. So whatever amount is adjusted in other equity other than towards capital reserve and securities premium on the conversion date. Conversion date means the last day of the immediately preceding year. Okay, so opening balance sheet we're talking about. So if the conversion year is 25-26, then we are talking about 31st March 2025. Okay, so whatever amount is adjusted in the other equity on this date, except the capital reserve and securities premium, and except these 5 items A, B, C, D, E, and F. So transition amount, you exclude capital reserve, security premium, and these 5 items. So whatever the remaining, the transition amount, such transition amount is to be adjusted in 5 years. Okay, first year and the 4 subsequent years. Now, what are these 5 items? Amount adjusted in OCI on convergence date, which shall be reclassified to P&L. So once if it will be classified to P&L, it's not required to be adjusted now. We will adjust it when it will be reclassified to P&L. Okay. Then these two are similar things. Now the other 4 are same. Revaluation surplus of asset as per Ind AS 16 and 38 adjusted on conversion date, or gain or loss from investment in equity instrument designated fair value to OCI as per Ind AS 109. Adjustment relating to asset recorded fair value as deemed cost as per Ind AS 101. Adjustment related to investment in subsidiary joint venture associate recorded fair value as per Ind AS 101, or adjustment in cumulative exchange difference, translation difference of foreign operation as per Ind AS 101. So all these are from B to E, B to F are the adjustment account of revaluation or designating the asset at fair value. So all these are not considered as transition amount, and we adjust the amount related to these 4 items at the time such items or the operation are actually transferred. So the above amount referred to in para B to F, the 4 amounts, shall be adjusted in the previous year where assets or investment of foreign operation, as the case may be, has been transferred. Okay, so similar to what we discussed at the time of continued India's companies. Okay, so what we discussed, we compute the book profit, we add some item in the net profit as per P&L account, we reduce some item and we compute book profit. But if the company is India's company, then we also make 2 more adjustments. Any amount credit to the OCI or debit to the OCI, as the case may be, under the heading not to be classified to P&L. And in these items also we ignore 2 things. One, the valuation surplus, or any amount towards change in the value of equity instrument on account of designating it at the fair value. Okay, these 2 amount is considered for MAT in the year of transfer of the asset or equity instrument, as the case may be. Okay, then if there is any amount debit or credit in the P&L account on account of distribution of non-cash asset to the shareholder and demerger, such amounts also ignored. Okay, then in the first year adoption, the transition amount is adjusted in 5 equal installments in the year of convergence and 4 subsequent years. Okay, For a transition amount, means any amount adjusted in other equity, except on account of capital reserve and security premium. And these except excluding these 5 items. First item is any amount to be adjusted in OCI, which will be reclassified to P&L. And the other 4 items are on account of revaluation or change in the carrying amount of the asset to the fair value as per India's 109 or 101. Okay. Now one more thing. If there's a APA, and on account of APA, there is some income which is debited, credited in the current year, but which relates to past years, or there is a secondary adjustment. Then, if this, in such case, the assessee makes an application to the AO and requests the AO to recompute the profit of the past year to which such income relates and the tax payable by assessee for the current year. So what happened if there's an AP and on account of AP there is some income which is booked in the current year which relates to the past years. Then the assessee has to make an application to the AO requesting him to recompute the book profit of the past year and to recompute tax payable by him for the current year. How it can recompute the tax payable? So whatever the tax payable is computed, you will reduce this amount by the amount computed by the formula A minus B minus D minus C. Meaning A minus B means A means the MAT on book profit including the past year income. B means MAT on book profit excluding the past year income. So it gives you a MAT which is there in the current year on the past year income. From this amount, you will reduce the MAT which was payable in past year had this income been included there only, minus MAT which you actually paid in the past year. So whatever excess amount you are paying now as a MAT shall be reduced. So this will help you. It makes a logic. So the excess MAT is reduced. Okay. And if this figure is negative, you will treat it as a 0. And see, if MAT is reduced, if book profit is reduced, then any excess MAT credit on this account should also be reduced. The tax credit allowed to assessee would be reduced by the amount which is equal to the amount of reduction that has been allowed under the account. Okay. But if such MAT credit has already been adjusted, then there will be no reduction in the book profit. The adjustment book profit shall be made only if the assessee has not utilized the credit of tax paid in a subsequent year under section 115J. Okay. So once I pay MAT, I'm eligible for MAT credit. And in this case, in case of APA, the provision of section 154 rectification of mistake apply, and the period of 4 years reckoned from the year in which said application received by the A. Okay. MAT is not applicable to a foreign company if it doesn't have a PE, or in case there is no DTL, it is not required to seek registration in India under the Companies Act. Okay. It's not applicable to foreign company who is paying tax under the presumptive scheme 44B, etc. MAT provision shall not apply to a company to any income arising to a company from life insurance business referred to in section 105B. Okay. MAT provision, as we discussed, is not applicable to company who opt for 115BAA, new tax regime 22%, or 115BAB, 15% concessional tax rate to new manufacturing or electricity generation company. All of the provision of the Act shall apply to every company mentioned in this section, being thereby. Even if MAT is applicable, you are required to pay advance tax. If advance tax is not paid, you are required to pay interest under section 234A, B, C, as the case may be. Okay. So all of the provisions shall equally apply to you, even if you are paying tax under section 115JB, you are not paying tax under the normal provisions. The company to which this provision applies shall furnish a certificate from a chartered accountant on or before 1 month before the due to furnish return of income. That is from the tax audit report. If profit and loss account is prepared as per Schedule 2 of the Companies Act, then AO cannot tinker with that profit and loss account. He can only make the adjustment in following two cases: where the profit and loss account is not prepared as per Schedule 2, or the accounting policies or accounting standard or method rate of depreciation adopted are different in the P&L prepared for each year. Okay, this we discussed in the beginning. So, what we discuss in the MAT? First, the company has to prepare the P&L account as per Companies Act. Okay. Why preparing such P&L account? For the purpose of MAT, it shall keep the accounting policies, accounting standard, method, data application same as it used for preparing P&L account for its AGM. Now, you will compute book profit basis such P&L account, and 15% of such book profit, if such 15% is more than the tax payable, then company is required to pay such 15%, the book profit should be deemed to the total income. Okay. However, for a unit in IFSC, which has its income in convertible foreign exchange, the MAT rate is 9% instead of 15%. For computing book profit, you will add reserve, provision for uncertain liability, income tax, deferred tax, provision for loss of subsidiary, provision for diminution in the value of asset, dividend, depreciation, valuation reserve in respect of asset which has been transferred even if not debited. Then expenditure in relation to falling income in section 10, 11, 12, and income from share of profit of in the AOP, the income capital gain of foreign company from transaction securities, interest, dividend, royalty, FTS, if taxable at a lower rate than the MAT rate. Then royalty in respect of patent, taxable under section 115 BBF. Then notional gain or loss on account of units of business trust are ignored, and only actual gain or loss is treated. So these items are similar in add and less. We are repeating this because you get a clarity that you need not to remember this item here also and there also. Okay. So in reduction, you reduce the amount withdrawn from reserve if the reserve was created from the P&L account, or reserve was added back while for book profit in any of the earlier years. Depreciation you have to reduce, earlier you add, here you reduce, but at the time of reduction you will ignore the revaluation. Any amount withdrawn from the revaluation reserve you will reduce to the extent such amount is relatable to the depreciation on the revalued amount. Then these income, which we discussed just in the addition part. Then the lower of brought forward loss on account of depreciation. However, the aggregate of both is allowed in case a company for which the application for insolvency is admitted, or for which the NCLT has suspended the board and appointed the new nominees of central government. Let's take industrial company. Okay. If largely for India's companies, important for you, the above book profit adjusted by the items stated in the OCI under the heading not to be classified to P&L account. You will not consider reversion surplus or the amount recognized on account of change in equity instrument designating at a fair value. These amounts are considered in the year of transfer. And lastly, any adjustment on account of transfer or distribution of non-cash assets to a shareholder in case of demerger. In case of first year of convergence, the transition amount is allowed in 5 years in equal installment. Transition amount means the amount adjusted in other equity except the capital reserve and security premium except these 5 items. Such item is any amount which can be classified to the P&L account, and the other 4 items are in respect of revaluation reserve or change in the carrying amount on account of recognizing these assets at fair value as per India's 109 or 101 as the case may be. Then lastly, we discuss about the APA. Okay. In case of APA, there is an income in the current year which relates to a past year. So assessee will make an application to the AO requesting you to become to the book profit of the past year and recompute tax payable for the current year. Okay. The book profit of the current year shall be reduced by the amount of excess book profit in the current year the book profit current year minus the excess which should have been offered in the earlier year when such income to such to the year in the year to which such income relates. Okay. But if book profit is reduced, then the MAT carry should also be reduced. But if MAT carry has already been adjusted, then no reduction in the book profit. Provision section 154 shall apply and period of 4 years shall be reckoned from the end of the financial year in which the AO receives the application. Then MAT is not applicable to a foreign company which doesn't have a PE or which is not required to be registered in India as per the Companies Act, or which is offering income under the presumptive scheme, or any income from a life insurance business, taxable under section 105B. All other provisions of the income tax act shall apply to the company which is paying tax under MAT. So that this company is required to pay advance tax, etc. Any company on which MAT applies is required to furnish a certificate from a CA along with its tax audit report. And the AO cannot make any adjustment in the profit and loss account which it prepares a P&L as per the provisions of the Companies Act. Now, last topic for this MAT credit. So if you are paying tax as per MAT, so the excess of tax over the normal provision is the MAT credit, which is allowed to be carried forward for 15 years. This MAT credit can be adjusted against the normal tax liability up to the MAT. So, if in year 1, there is a normal tax liability and MAT liability. So, normal tax liability of 100 and MAT liability of 150. Then the company is required to pay MAT 150, the 50 rupees shall be allowed as a MAT credit. And in year 2, if the normal is 200 and MAT is 180, then out of this 50, 20 can be used and company shall pay 180 and 30 shall carry forward to the next year. Okay. An assessee who pays MAT in any year shall be eligible for MAT credit. MAT credit equal to MAT paid meant tax payable under normal provisions, so excess of the MAT paid. Of course, in case of company claims FTC, MAT credit computed above shall be reduced by the following amount. Means the FTC allowed against MAT minus FTC that would have been allowable against tax payable under normal provision. MAT credit is carried forward for 15 assessment year from the annual assessment year in which it becomes allowable. So for 15 years, it's allowed. MAT credit shall be utilized in the year in which tax is payable under normal provisions. MAT credit can be utilized to the extent of tax payable under normal provision minus MAT payable in such year. So every year company has to pay at least MAT. When any assessment, reassessment, the tax payable or the MAT is changed, the MAT credit also increase or decrease accordingly. Okay. So this was MAT. Now let's do some question in respect of minimum alternate tax. So question number 1 says, a domestic company ABC Limited furnished the following particulars in respect of assessment year 26-27 and seeks your opinion on the application of section 115 JP MAT. You are also required to compute total income and tax payable. So this is a domestic company and it has given the profit and loss as per the P&L account and some adjustment, and we are required to compute the okay. So for this, whether MAT is applicable or not, we have to compute the income under the normal provisions, tax on such income under the normal provisions, then book profit, MAT, and then we have to compute this tax and the MAT. Okay. So profit as per the statement of profit and loss account is 215 lakh. Statement of profit and loss account includes credit. So these entities are credited in the P&L account. Dividend income 20 lakh. Excess relies on sale of land held as investment. So there is a sale of land during the year, and there is a profit, accounting profit of 30 lakh, which is credited in the P&L account on account of such sale. Then these two items are debited in the P&L account, among others. Depreciation on straight line method 100 lakh. Provision for loss of subsidiary company 60 lakh. So these two items are debited. Now it says depreciation as per the Income Tax Act is 150 lakh. The short-term capital gain on sale of land mentioned above as compared to the Income Tax Act is 40 lakh. There's sale of land on which accounting profit is 30 lakh, but the short-term capital gain as per income tax is 40 lakh. Loss brought forward as a books of account and as per Income Tax Act is loss is 50 lakh and amount of depreciation is 60 lakh. So we will first compute the income under the normal provisions. So we'll start with 215 lakh. Then dividend is taxable under head other sources. We will reduce it while computing the PGBP and include it under the head other sources. This excess 30 lakh rupees is again reduced for PGBP income, and the 40 lakh short-term capital gain shall be taxable under that capital gain. That is 100 lakh of depreciation shall be disallowed, and we will claim a deduction of depreciation as per income tax 150 lakh. Then provision of loss of subsidiary is not allowed under the normal provision as well. 60 lakh. Then the business loss and another depreciation shall be allowed under the normal provisions. So if you see total income as per the normal provisions, we start with 215 lakh. The depreciation of 100 lakh is added back, which is already debited to P&L account. And this 150 lakh as per the Income Tax Act shall be reduced. Then provision for loss of subsidiary are not allowed. Under normal provision, it is added back. Dividend and gain on sale of land are reduced. They are already credited, but they will be taxed under the different head. So while computing PGBP, we have reduced it. Now, the business loss of 50 lakh shall also be allowed under the head PGBP. So the PGBP income shall be 125 lakh. Now there is a capital gain of 40 lakh and other source income of 20 lakh. So the GTI comes at there is a 185 lakh. Now against the 185 lakh, we can claim another depreciation of 60 lakh, and therefore GTI comes 125 lakh. Clear? No doubt? Okay. Now we'll apply the normal tax rate. The company is not claiming 115 BAA. Of course, had it been claiming 115 BAA, then there is no question of MAT, because MAT is not applicable on companies opting for 115 BAA or 115 BAB. Okay. So the total income is 125 lakh, and it also says turnover of the company for PY 23-24 was 390 crores. So it was less than 400 crore. So company is eligible for 25% tax rates. So 125 lakh will apply the 25% tax. It comes 31 lakh 25,000. Since the income exceeds 1 crore, 125 lakh, there's surcharge of 7%. It comes to 33 lakh 43,750. Add cess of 4%, the tax payable under normal provisions comes to 34 lakh 77,500. Clear? So this was computation as per the normal provisions without MAT. Now we do a similar computation under the MAT. So here I have to compute my book profit. For book profit, I start again with 215 lakh. Now dividend. It says while computing book profit, dividend has to be added. But whose dividend? That dividend is the dividend declared or proposed by the company, by the assessee. It's a dividend which has been received by the assessee. So no treatment. Excess relies on sale of land. No adjustment. While computing book profit, we saw no item dealing with it. Depreciation 100 lakh. This has to be reduced. This first it has to be added by and again reduced except the revaluation. There is no revaluation. So I will add 100, reduce 100. First adjustment. Provision loss of subsidiary is to be added by computing book profit. The second adjustment. So the 100 lakh adjustment has no impact. It is added and reduced at the same time. But the 60 lakh adjustment has an impact. So my book profit shall be 215 plus 60. Okay, so it comes to 275. But I will reduce the another depreciation of book loss, whichever is less between these two. So I reduce the 50 lakh. So my book profit comes at 275 minus 50, 225. Now I apply 15% of this 225. It comes at 33 lakh 75,000. Now since book profit is 2 crore 25 lakh, there's surcharge of 7%. I said all other provisions shall applicable. So there's surcharge of 7% and cess of 4%. So MAT liability comes at 37 lakh 55,700. Yes. So there's a question why such provision of adding first and then reducing depreciation is there. Is it due to depreciation on revalued portion of asset? Of course, you have already answered. So I add back the entire depreciation. But when it comes to reduction, I reduce only the depreciation except on the valuation amount. So I ignore the depreciation on revaluation amount. So I don't allow the reduction of depreciation in respect of revaluation amount by adding a lesson. Okay. So now in this question, thank you. Thank you, Ma. So now in this question, I'll compare this MAT liability, 37 lakh 55,700 with the liability under normal provision, 34 lakh 77,500. Whichever is higher, I will pay. So here the higher amount is the MAT liability. So I'll pay, I mean the company shall pay this much amount. But since the company is paying the higher amount under the MAT, so it shall be eligible for a MAT credit of an amount equal to this 37 lakh 55,700 minus 30 tax under normal provisions, 34 lakh 77,500. Clear? So the company shall be liable to pay 37 lakh 55,700 is a tax payable, and the book profit 225 lakh shall be treated as the total income of the company for this year. Okay. Question 2 says, Mathri Jeans Private Limited is in the business of manufacturing jeans. Okay. For the assessment year 26-27, it paid tax at the rate of 15% group profit computed under section 115 JB. So for this year, the company is paying tax under the MAT because MAT liability must be more than the normal liability. Okay. The AO, though satisfied that it is liable to pay book profit tax under section 115 JB, wants to charge interest under section 234B and C as no advance tax was paid during the financial year 25-26. So AO agreed to the fact that the company is able to pay tax under MAT, but it says since you have not paid advance tax, you are liable to pay interest under section 234B and C as the case may be. The company seeks your opinion on the proposed levy on interest, and companies of the opinion seems to be of the opinion that since once the MAT is applicable, it is not required to pay advance tax, and therefore consequent interest should not be applied. But here, as we discussed, even if the company is paying MAT, all other provisions of the act is applicable. The company is required to pay advance tax, and therefore, the AO is correct in his view that if there is a default in payment of advance tax, the company is liable to pay interest under section 234B and 234C of the Act. So there is a case on this point by the Supreme Court. You are not mandatory required to remember the name of the case. You must know the provisions and the rationale of the case and the conclusion of the case. Okay. Last question for the MAT. Sona Limited, a resident company, earned a profit of rupees 15 lakh after debit or credit of the following items to the statement of profit and loss for the year ended 31st March 2026. So it has earned a 15 lakh profit after debiting crediting these items. Okay, let's see. Item debited to the P&L account, item credit to the P&L accounts. Then there's some other information, but let's see what's the requirement of the question. Compute minimum alternate tax under Section 115JB of the Income Tax Act 1961 for AY 26-27. Assuming Sona Limited is not required to comply with Indian accounting standards, Indians. Ignore the provision of Section 115BAA. Suppose I will ignore, because if I will not ignore, then I cannot compute the MAT, because MAT is not applicable to company opting for 115BAA. So here in this question, the question is not asking me to compute the normal provisions. See, if you see in question number 1, the requirement was compute total income and tax payable. So I was required to compute tax payable, and for this I have to compute tax under normal provision and under MAT. And on comparison of the both, I can only come to a conclusion the amount of the tax payable. But here the question specifically asked me compute MAT under Section 115JB. Okay, so only I have to compute the book profit and then apply 15% on such book profit. So such as the case may be. So I'll start with 15 lakh. Now, what are the items which is debit to P&L account? I have to see whether I need to add any of these items. Provision for loss of subsidiary, yes, I have to add it. It's specifically stated in Section 115JB. Provision for doubtful debt, yes, because the provision for diminution in the value of asset. What is the asset? Asset is a debtor. So there's a provision for diminution in the value of debtor, and therefore I have to add it back. Provision of income tax, specifically stated. Provision for gratuity based on actual valuation. Since this provision of gratuity is based on actual valuation, it is treated as a certain liability. So it's not an unascertained liability and therefore need not be added back. Depreciation, I add back and reduce without revaluation if there is any. Interest to financial institution, unpaid. Even if unpaid, it's actually disallowed under the normal provision under Section 43B. But under MAT, there is no such adjustment required. Penalty. So whenever we saw the MAT, computation book profit, there was no item which requires us to add penalty. The computation book profit is very much limited to the 115JB. Whatever item is there, this exhaustive list. I can't apply my mind. So I'll go by the whatever item is listed in 115JB. Okay. So these two items are not listed, so I will not adjust. Now items credited. I'll see whether I need to reduce it. Profit from unit established in SCZ. So talking about Section 10AA deduction. But there is no such item. It doesn't say that MAT is not applicable on SCZ profit. MAT is not applicable on Section 10 income. But SCZ profit are allowed deduction under Section 10AA. So MAT is applicable. Share in income of an AOP as a member. I can reduce this if this is exempt under Section 86. Income from units of UTI 75,000 and long-term capital gain on sale of building. If any gain on sale of building is there in the P&L account, I cannot reduce it for computing book profit under MAT. Now there is other information. Depreciation includes 1,50,000 on account of revaluation. Now the question which the Umang asked is answered here. So it says the depreciation 3,60,000. It includes 1,50,000 on account of revaluation. So while computing book profit, I'll add 3,60,000, but I will reduce only 2,10,000. 3,60,000 minus revaluation. Okay. Depreciation as per income tax rule is 2,80,000, not relevant for MAT purposes. Brought forward loss as per books of account of the company is 10 lakh, which includes unabsorbed depreciation of 4 lakh. So I have to compare loss without depreciation with the depreciation. So loss without depreciation is 6 lakhs, 10 minus 4, and the depreciation is 4. So whatever is lower, 4 lakh, I reduce 4 lakh. The AOP of which the company is a member has paid tax at MMR. Now, since AOP has paid tax, such share of profit is exempt in my hand, in the hands of the company. And since this income is exempt in Section 86, it is not liable for MAT. So I will reduce it. provision for income tax include 45,000 of interest payable on income tax. So this provision for income tax of 1,05,000. It says it includes 45,000 towards interest. So the MAT provisions say the income tax shall include the income tax, surcharge, cess, interest, dividend distribution tax. So the interest is also not allowed as deduction for computing the book profit. So entire 1,05,000 is to be reduced. Now let's see computation book profit. So I start with 15 lakh. I'll add provision for loss of subsidiary and provision for doubtful debt, being the provision for diminution the value of the asset. Asset being the debtor. Then entire 1,05,000 has to be added back, including the interest. And 3,60,000 depreciation is added back, and in deduction is 2,10,000, ignoring the revaluation. Okay. Then share of member is reduced, not liable to MAT, because the AOP has paid tax at MMR. Now, the lower of another depreciation or book loss is allowed a deduction, which is 6. I compare 4 and 6. I will not compare 4 and 10. You understand why? Because I'll compare the loss without depreciation with the depreciation. Here the loss of 10 lakh is including depreciation. So first I exclude depreciation and the loss becomes 6 lakh, and the another depreciation is 4 lakh. I'll compare these two figures, whatever is lower, I shall allow the deduction for computing book profit. Okay. So my book profit came 14 lakh, and the MAT shall be 14 lakh into 15%. There is no surcharge. Why? Because the book profit are less than 1 crore. The surcharge is applicable only once the book profit exceeds 1 crore. So the profits are only 14 lakh. No surcharge. I will only apply the cess 4%. The MAT liability is 2,18,400. But I am not sure I am required to pay this, because to compute tax payable, I have to compute the tax liability in the normal provisions. And then such tax liability has to be compared with this MAT liability. And then only I will come to a conclusion whether I need to pay MAT or tax as per the normal, whichever is higher I have to pay. Okay. Hope I am clear till now. We discuss the meaning of the company, domestic company, Indian company, and widely held company, company in which public are substantially interested. Then we discuss the tax rate and the old regime, and the new regime 115BAA 22%. Then we discuss section 115BAB, benefit provided to a new manufacturing entities or electricity generation companies, domestic companies. Then we discuss in detail the MAT, the provision of the MAT in case of India's companies, MAT credit, the foreign companies on which MAT is not applicable, yeah, and other provision for MAT. Okay. Then we practice some of the question to understand the concept. Okay. Now we'll break for a small break, for a small water break of 5 minutes. It's 7:30. We'll meet again on 7:35. Okay, small break. So we discussed till now different types of companies, Indian company, foreign company, and any association which is declared by the board as a company or as such as a company. Then the domestic company means Indian company or any other company which has made prescribed arrangement for taxation of dividend within India in respect of its Indian taxable income. Then we discuss what do you mean by Indian company means a company registered under the Indian Companies Act or any corporation established in the Central State or Provincial Act or any institution, association body declared by the board as a company. Then we discuss the definition of a widely held company, company में public are substantially interested. Okay. It mainly includes the company whose shares are listed or whose shares at least 50% shares are held by the cooperative society throughout the previous year, or 40% shares are held by the government or the RBI or corporation owned by the government, or Section 25 or Section 8 companies, or mutual benefit finance companies, or any company which is declared by the board to be a company with public are substantially interested. Okay. A subsidiary of a listed company or subsidiary of a listed company is also treated as a company with public are substantially interested. Okay. This provision is applicable is useful for in respect of some of the provisions of the Act which we discussed. Then we discuss tax rate in the old regime for domestic company and foreign company, and in the new regime in section 15 BAA 22%. Okay. Then we discuss the section 15 BAB applicable to new manufacturing or electricity generation company allowed to pay tax at a concession rate of 15% on such income, provided they started the operation on or before 31st March 2024 and they incorporated on or after 1st October 2019. Okay. Some of the deductions are not allowed while computing if you opt for section 15 BAA or 15 BAB as the case. Okay. Then we discuss in detail the MAT, which we have already discussed, the item to be added back, item to be reduced, Ind AS, MAT credit, and the companies on which MAT is not applicable. Okay. Now, then we discuss MAT in case of APA. Now we'll move to the AMT. So as there is a MAT for companies. So MAT is minimum alternate tax for the company. What we do in this case, we compare the MAT liability with the normal tax liability, but MAT is applicable only to a company if the assessee is a company. But if the assessee is any person other than company, then similar to MAT, there is a provision of AMT, alternate minimum tax. MAT is applicable at the rate of 15%, while my AMT is applicable at the rate of 18.5%. This AMT is applicable to all entities except the companies, because for companies there is a MAT, and for all other assessees there is AM. But like MAT, there is no such big computation of book profit in case of AMT. See, MAT starts with the book profit, net profit as per the P&L account prepared in accordance with the Companies Act. While computing AMT, the computation starts with the total income as per the normal provision. See, AMT is applicable only in case where the assessee is either claiming deduction under section 35 AD or part C of chapter 6A, except section 80P. See, AMT is applicable only if you are claiming a deduction under chapter part C or chapter 6A, except 80P, or section 35 AD, or section 10 AA, procedure. Sir, one question regarding 115 BAP. Okay, what happens in case if company is involved in both one manufacturing business, one trading business? As in one of the part of the table given module for 115 BAB, it is given that no deduction of expenses allowed, so I have to pay tax on trading business sale at 22%. Yes. So if you're opting, see, 115 BAB is not a mandatory section. It's an option. So if you're opting for 115 BAB, then you have to pay concessional tax of 15% only in respect of manufacturing business. And any other income except the special income is taxable at 22% gross basis. Okay. To come back to AMT, AMT is applicable only in case of assessees, other than companies, of course, who are either claiming deduction of Chapter 6A, the Part C deduction, means the profit link deduction, except deduction of Section 80P, or claiming deduction of Section 10AA or 35A. On these three types of deduction, if you are claiming, then AMT is applicable. And if you are assessee other than the company, okay. So if in a question you saw any of these three types of deduction, then you must get conscious that you have to compute AMT as well if the assessee is other than a company. What it says, if regular income tax payable by a person other than a company is less than 18.5% of the adjusted total income, ATI, such adjusted total income shall be deemed to be a total income and tax shall be payable at the rate of 18.5% such adjusted total income. So you got it? Similar language as was there in the MAT. So if your adjusted 18.5% adjusted total income is more than your tax liability in the normal provision, then you are required to pay 18.5% of your adjusted total income as tax payable. And in such case, the adjusted total income shall be deemed to be your total income for this year. Okay. But this AMT is applicable only if AMT is applicable if assessee has claimed what? Either any Part C deduction, Part C of Chapter 6A, except deduction applicable under Section 80P available to cooperative society, or deduction Section 10AA on account of SCZ, or Section 35AD. Okay. If SSC has claimed either of these three, then you have to compute AMT even if the question is silent about the AMT. So, AMT is applicable if SSC has claimed deduction under Part C of Chapter 6A other than Section 80P or 10AA or 35AD, and in case of individual HUF, AOP or BOI or AJP, the adjusted total income exceeds 20 lakh. So if your adjusted total income, if you're an individual HUF, AOP, BOI or AJP, if your adjusted total income is less than 20 lakh, even though you have claimed this 10AA or 35AD or Part C of 6A, still AMT is not applicable. So generally AMT is applicable if the assessee has claimed any of this deduction. But if the assessee is individual HUF, AOP, BOI or artificial juridical person, which are eligible for the slabs, okay, this category of person are eligible for slab rate of tax. You know, they have a basic exemption limit. So if you are this person, then AMT is applicable if you satisfy two conditions. One, you claim either any of these three deductions and your adjusted total income exceeds 20 lakh rupees. Okay. Similar to MAT, if the assessee opt for the new tax regime, then AMT is not applicable. AMT shall not apply if the assessee is opting for concessional tax rate under Section 115 BAC or BAD, as the case may be. Similar to MAT, as in case of MAT, the unit of IFSC was subject to MAT rate of 9% to 15%. Similarly, such units eligible for AMT rate of 9% here also. And in case of cooperative societies, the AMT rate is 15% instead of 18.5%. For all other assessees, it's 18.5%. Okay. This chart explains the applicability of MAT, AMT. If you are a company, then AMT is not applicable because you are subject to MAT. If you're any person other than a company, then if you're individual HUF, AOP or BOI or AJP, then you see whether you have claimed any one of these three deductions 10 AA, 35 AD or Part C of Chapter 6A? If answer is no, no MAT is applicable. If answer is yes, then you have to see whether you have opted for the new regime. If answer is yes, then no MAT is applicable because MAT is not applicable if SSC opts for the new regime, similar to MAT. If answer is no, then you have to see what's your adjusted total income. If it exceeds 20 lakh, and yes, then AMT is applicable. If no, then no AMT is applicable. Okay, so this is exhaustive chart. If you're a cooperative society, then instead of these three, only two conditions applicable on you. First, you have to see whether you have claimed these three deductions. If yes, then whether you opt for the old regime. If no, then only AMT is applicable. Okay. If you're any other person, like partnership firm and all, then only one condition you have to see whether you have claimed any of these three deduction. If answer is yes, then AMT is applicable. What are the rate of AMT? General rate of AMT is 18.5%, but for cooperative societies, it is 15%. And for unit of IFSC, it is 9% if such unit is driving income in convertible foreign exchange. Clear? So for individual HUF, AOP, BOI, artificial judicial person, there are three conditions. They must claim any one of these three deductions, deduction section 10 AA or 35 AD or Part C of Chapter 6. They must not opt for the new regime. And lastly, their adjusted total income must exceed 20 lakh. But if the assessee is cooperative society, then the condition of 20 lakh is not applicable. And if the assessee is any other person, then even the logic of old regime is not applicable because there is no such old or new regime for partnership fund. Now, how this adjusted total income is computed? So as I told you, here we'll start with total income as per the normal provisions, and we add the deductions which you have claimed. Which deduction? These three deductions. So Part C of Chapter 6A or 10 AA. But if you have claimed deduction section 35 AD, so if you know what is 35 AD, it says the capital expenditure is allowed in the year in which it is incurred. So if you have claimed 35 AD, then you will add such capital expenditure, but at the same time, you will reduce the depreciation which was otherwise allowable if you had not claimed 35 AD. So if you have purchased some asset for the purpose of business and you satisfy the condition of section 35 AD, then you can claim the entire capital expenditure of such asset on such asset as deduction in the same year. But if you are not opting for 35 AD, then even then, at least you will be allowed depreciation. So this it says, we will add back 35 AD deduction, but we will reduce the depreciation which you would have been allowed on such asset. The total income is added by the deduction chapter 6A or 10 AA or deduction claim under section 35 AD as reduced by the amount of depreciation allowable in section 32, as if no deduction was allowed under section 35 AD in respect of such asset. So understood? The first 2 points are straightforward, vanilla. But in respect 35 AD, you will add 35 AD. At the same time, you will reduce the amount of depreciation which was otherwise allowable. Okay. So similar to MAT, there is AMT credit. The same computation. So what is AMT credit? AMT paid in excess of normal tax. The excess is the credit which is allowed for 15 years. Okay. And this excess can be adjusted against the normal tax up to the amount of AMT. Okay. The only one difference is that this AMT credit can be adjusted even in the year in which the assessee is not required to pay AMT or is not required to compute AMT on account of its adjusted total income being less than or up to rupees 20 lakh. Okay. So it says an assessee who pays AMT in annual year shall be eligible for AMT credit. Everything is similar to MAT. AMT credit equal to AMT paid minus tax payable under the normal provision. AMT credit shall be carried forward up to 15 years from the end of the assessment in which it became allowable. AMT credit shall be utilized in the year in which tax is payable under the normal provision. AMT credit shall be utilized to the extent of tax payable under normal provision minus AMT payable. AMT payable shall be available even in the year in which assessee is not liable to pay AMT. So even if in the year in which its adjusted total income is less than 20 lakh, even in such year, it can claim the AMT credit if it is brought forward. However, no credit can be available in the year in which assessee opt for the new regime. Okay. So once you opt for the new regime, your brought forward AMT credit lapse. So very simple say examples to make you understand the AMT credit. This is applicable to MAT credit as well. So in case one, if there is normal tax of 1 lakh and AMT payable is 1,50,000. So you pay AMT of 1,50,000 and there is an AMT credit of 50,000 which you will carry forward. In year 2, there is a normal tax of, so the year 1 is similar for all the cases. In year 2, there is a normal tax of 2 lakh and AMT is 5 lakh. Now since here in year 2 also you are liable to pay AMT, you cannot utilize the AMT credit. So the borderline is, in any year you cannot pay less than the AMT. Okay. So in second year also you will pay the AMT of 5 lakh and there is a 3 lakh AMT credit in this year. 50,000 are brought forward. So total AMT credit carried forward is 3,60,000. In case 2, in year 2, there is a normal tax of 2,50,000 while AMT is 1 lakh. So now you are liable to pay normal tax so that you can adjust AMT credit of 50,000. So you will pay only 2 lakh. 2,50,000 minus 50,000, 2 lakh. And the AMT credit carried forward shall be nil. You have utilized it. In case 3, the normal tax is 250 and the AMT is 2,20,000. Though you are paying the normal tax, but you can utilize the AMT credit only till the extent of difference between the normal tax and the AMT, which is 30,000. So the nutshell is you have to pay at least the AMT in each year. So you pay 2,20,000 and the remaining 20,000 of AMT credit shall be carried forward. Case 4, there is no AMT applicable in this year. So the AMT credit whichever is there, 2,000 shall be adjusted against the normal 2,50,000. So you will pay 2 lakh and the AMT credit carried forward shall be nil. So hope it's clear. So this was about AMT. So whenever you see a question where there is a deduction on account of Part C of Chapter 6A except ATP or 10AA or 35AD, you must get conscious that there is applicability of AMT. Okay. Question number 4. Mr. Rajesh has income of rupees 45 lakh under the head PGBP. One of his businesses eligible for deduction at the rate of 100% of profit under Section 80 IB. It is a deduction under Part C of Chapter 6A, profit link deduction. The profit from such business in the business income is 20 lakh. So he has earned 45 lakh. Out of this 45 lakh, 20 lakh is from the business which is eligible for 100% deduction under Section 80 IB. Compute tax payable by Mr. Rajesh, assuming he has no other income for period 25-26 and he has exercised the option to shift out of default tax regime. So once he has shifted out of the default tax regime, he has opted for the old tax regime and there is a deduction under Part C of Chapter 6A. Then though question is not saying anything about AMT, but I have to compute AMT because AMT becomes applicable. So first I'll compute the normal. Under normal tax, so normal income is 45 lakh minus deduction 20 lakh, 25 lakh. I'll apply the slab rate under the old regime. What is slab in the old regime? No tax up to 2.5 lakh, 5% from 2.5 lakh to 5 lakh, 20% from 5 lakh to 10 lakh, and then 30%. Okay. So I will apply this slab rate on 25 lakh. There is no surcharge. Total income is 25 lakh. Surcharge is applicable only if the income exceeds 50 lakh. So whatever tax I compute, I'll add 4%. That shall be tax liability in the normal provision. So normal income is 25 lakh. I'll apply the slab rate. Tax comes 5,62,500. I'll add the cess 4%. The normal tax liability comes at 5,85,000. But now since he has opted out of the default tax regime, he has opted for old tax regime, and he has claimed a deduction under Part C of Chapter 6A. I have to compute the AMT as well. So what is the adjusted total income? I start with the income computed in normal provision 25 lakh, and I add the deduction claim under Part C, which is 20 lakh. So the ATI shall be 45 lakh. Now, he's a individual. So the AMT rate is 18.5%. I'll apply 18.5% of this 45 lakh. 8 lakh 32. There's no such a because the ATI is less than 50 lakh. So there's only a cess of 4%. The AMT is 8,65,800. Vis-a-vis the tax under normal provision of 5,85,000. So I'll pay whichever is more. So I'll pay the AMT, but I will allow the AMT credit of the difference between this and the normal provision of tax under normal provision as AMT credit, which I can carry forward for 15 years and set off against my normal tax liability to the extent of AMT. So I pay 8,65,800, but I'll be eligible for a credit of 2,80,800, being the difference between the AMT and the tax under the normal provisions. Such AMT credit can be carried forward for 15 years. So the question, if you notice, the question is very small and nowhere talks about or gives a hint of the AMT. But since there's a deduction under Part C of Chapter 6A and assessee has opted out, you have to compute the AMT. If you not compute the AMT, you will lose most of your marks. Because if you see, the answer is only the AMT is table. If I have concluded my answer here, then I have reduced almost half of the marks for the question awarded to the question. Okay. So this was very small, easy concept. Now we are moving to, this was all about taxation of a company. Now I'll move to taxation of firms. So what I'll do here, we'll discuss some of the specific provision under the entire act, which is applicable only in case of partnership firm. So when I talk about partnership firm, the first provision which comes to your mind is Section 40B. What this provision says, it restricts the allowability of salary and interest payment by a partnership firm to its partner. So it's give some conditions, some limits. In excess of such limits, the interest or salary payment are not allowed. So what it says, firstly, it says that interest shall not be allowed in excess of 12%. Okay. So if any partnership firm is paying interest more than 12%, the excess amount shall not be allowed as deduction in the hands of the partnership firm. One. So in respect of interest, it only says that it cannot be allowed if it exceeds 12%. Interest is allowable to both working and the non-working party. What is working party? We'll discuss in a minute. Okay. So the only condition is that it should not exceed 12%. If it exceeds 12%, the excess shall be disallowed in the hands of the partnership firm. Okay. There are some more conditions attached to it, but those conditions are common for interest and salary, and we will discuss at the same time. Now about salary. The first thing is the salary or the remuneration, as the case, whatever you call, shall be allowed only to the working partner, shall not be allowed to the non-working partner. Here, the meaning of working partner becomes important. But also in case of working partner, it is allowed subject to some limit. So limit is qua book profit. These book profit is not same as the book profit we studied for the purpose of math. Okay. So it says if the book profit is more than 6 lakh, so for the first 6 lakhs or in case of loss, the maximum deduction, the aggregate deduction in respect of remuneration payable to partners is 3 lakh or 90% such book profit, whichever is more. And on the balance of book profit, it is 60%. Okay. Now, if you read, a firm means a partnership firm, shall be allowed deduction of salary or remuneration payable to partners subject to the following. An amount of interest paid in excess of amount calculated at 12% per annum shall be disallowed. What is this interest? This interest includes interest on capital account. If there is some current account which the partnership firm maintains in respect of its partner, the interest on current account, or interest on loan given by a partner to the partnership firm. Any type of such interest, the rate of interest is restricted to 12%. If the firm is paying more than 12%, the excess shall be disallowed in the hands of partnership firm. This interest can be paid to any partner. It nowhere said it has to be paid to the working partner. So even if interest paid to a non-working partner, still it is allowed up to 12%. Okay, the rate of interest should be 12% or less. Now we talk about the remuneration. Remuneration payable to any non-working partner shall be disallowed. So at first, the remuneration allowed only to the working partner. So whatever remuneration you pay to the non-working partner, disallowed at first instance only. Okay. Working partner means who are actively engaged in the business of the firm. So it nowhere says that the working partner should work full time. So even if a person is a partner in two firms, he can be a working partner in both the firms. Okay. Then it's not necessary that the person should be engaged in all the business. He may take care of the purchase, he may take care of one side of the operation, and or other side of the operation. Okay, it's not necessary that he should be taking care of everything, the purchase, sales, finance, HR, everything. No. Okay. He should be actively engaged. So if you're non-working partner, if you're not at all engaged in the working of the firm, then the remuneration paid to you is disallowed at first. Then if you're a working partner, the remuneration is allowed but subject to the following. The remuneration payable to all partners in excess of the aggregate of the following amount shall be disallowed. So what is this? Is the limit for aggregate remuneration payable to the partner, payable to the working partners. Because remuneration payable to non-working partners is at first disallowed. On first 6 lakh of book profit, or in case of loss, the remuneration allowed is 3 lakh or 90% of the book profit, whichever is more. On balance of book profit, 60% of the book profit. Okay. Now, what is book profit? I told you it's not the same as what we discussed. Because in profit means PGBP as increased by the aggregate amount of remuneration payable to all partners of a firm if such amount has been deducted while computing the net profit. So book profit means PGBP. It's not the profit as per P&L account. It's the taxable PGBP as increased by this remuneration payable to all partner of the firm if such amount has been deducted while computing profit. So you compute the PGBP and you add the remuneration payable to the part. So whatever amount you got is the book profit. So for computing book profit, you do the computation at the head PGBP. So you will reduce the brought forward unabsorbed depreciation because such depreciation reduced under section 32(2), which is under the PGBP head. But you will not make adjustment of brought forward business losses because such adjustment is made under chapter 6, not under the head PGBP. Okay, understood? So I'll make a computation under the head PGBP and I will only do one thing. I'll add the remuneration which is debited in the P&L account towards the working partner. Whatever amount I get is the book profit. Then I'll apply this limit. On first 6 lakh, the limit is 3 lakh or 90%. On the balance, it is 60%. So whatever the amount I get by applying this limit, this amount is the maximum amount of remuneration which is allowed in respect of all the partners, not one partner. It's the maximum amount of remuneration which the firm is allowed in respect of all the partners. Okay. Now, notwithstanding the above means the above shall not be allowed. The remuneration or interest shall not be allowed. Even if, as per the above limit, even such remuneration or interest Even if you are paying interest at less than 12%, even such interest shall not be allowed if the same is not authorized by or is not in accordance with the partnership deed. So if the partnership deed explicitly doesn't say about payment of interest, the rate and the payment of remuneration and the amount of such remuneration or manner of computation of remuneration, if partnership deed is silent, then such interest or salary shall not be allowed. So the partnership interest must authorize to pay the interest or salary to the partner. Okay. And such authorization shall be prospectively. So such interest or salary shall not be allowed if it relates to the period prior to the date of partnership date for which such payment was not authorized or is not in accordance with any earlier partnership date. I explain it. So there is a partnership date entered on 1st April 26, which is silent in respect of salary to partner. Okay. Now, on 1st October 26, the partners enter into a supplementary partnership deed. Okay. And its supplementary deed says that the partner shall pay the salary of rupees, say 50,000 rupees per month with effect from 1st April 26. So my provision says that since this 50,000 salary is now been authorized by the partnership date, but since it relates to the period prior to the date of entering of this partnership date, this supplementary deed is entered on 1st April 26, which provide for this payment of salary. But since the deed which provides for payment of salary is entered on 1st October, any salary authorized by it from retrospective date shall not be allowed. So the firm shall not be allowed a deduction of salary paid from 1st April to 1st October. The salary payment shall be allowed only with effect from 1st October when the supplementary date is signed. So no retrospective applicability of the partnership deed for salary or interest. Okay. The salary or interest shall not be allowed if the firm has defaulted in any of the conditions specified in section 144, ex parte assessment, or firm does not comply with provision section 184, which we'll discuss in a minute. Okay. So in all these 3 or 4 cases, the salary or interest, even if as per section 40B, shall not be allowed to the partnership. What are these cases? 1, if the salary or the interest is not authorized, that's not allowed. 2, even though authorized, but relates to the period prior to the period when the partnership deed is entered, which authorize it. Okay. Third, if the partnership firm has failed to comply with the condition provided in section 144 or had defaulted, does not comply with the provision of section 184. If any of this default has occurred, any of this 4 situation has occurred, then the partnership firm is not allowed a deduction of salary or interest. One more thing. Whatever the deduction is allowed to the partnership firm who has salary or interest, only such amount is taxable in the hands of partner as his PGBP. So there is no double taxation. If the firm has paid rupees 100 to a partner as salary, but the deduction of rupees 60 is allowed to the partnership firm in respect of this salary. Now, even though the partner has received rupees 100, he only rupees 60 shall be taxable in his hands because the tax on rupees 40 has been paid by the firm. Because firm has been allowed only 60 rupees. So rupees 40 has been disallowed in the hands of the firm, and firm has paid tax on rupees 40, and therefore this 40 tax on this 40 has been paid by the firm. So tax on this 40 shall not again be paid by the partner. So partner shall be liable to pay tax only on rupees 60. Okay. Whatever amount has actually been allowed to the firm. Say the firm has paid 18,000 as interest to the partner at the rate of 18%. That only 12,000 is allowed to the firm, and this 12,000 shall only be taxed in the hands of the partner, even though he has received 18,000. Assuming you are a non-working partner and the firm has paid you a salary of rupees 1 lakh, then this entire 1 lakh salary is disallowed in the hands of firm because you are non-working partner. And even though you have received a 1 lakh rupees salary, nothing is taxable because nothing has been allowed in the hands of the firm. The firm has already paid the entire tax on this 1 lakh. Okay. Similarly, if the salary or interest is not allowed on account of these three or four non-compliances, then to the extent this is not allowed, this is not taxable in the hands of partner as well. Okay. Okay. Now, small concept. See, if a HUF is a partner in a firm, then HUF is represented by a Karta. So, since the HUF is a partner and the Karta is only acting in a representative capacity, so any interest paid by the firm to the Karta in his individual capacity, meaning thereby the Karta has given a loan in his individual capacity to the partnership firm. So, on such loan, the partnership firm is giving the interest. Such interest is not subject to section 40B because it is not paid to the partner. The partner is HUF and Karta is only a representative to the HUF. Okay. So it says, if individual is a partner of a firm in representative capacity, interest paid by a firm to such individual in his individual capacity shall not be disallowed. So is a partner HUF and the Karta is only acting as a representative. And any interest received by him in his individual capacity, not in representative capacity, he is not receiving interest on behalf of HUF. The loan is given by him in his individual capacity. Then section 40B shall not be applicable. Similarly, if he is partner in individual capacity and the loan is given by the HUF and interest is paid to him in a representative capacity on behalf of HUF, then such interest is also not subject to section 40B, of course. 40B is applicable only if the interest is payable to the partner. As we discussed, flexibility of the amount received by partner. So what a partner receive? A partner generally receive a share of profit from the firm, which is exempt in a sense. The partner share in the total income is exempt under section 10(2)(a). Salary or interest, they are taxable under that PGBP only to the extent the same is allowed a deduction to the firm. You understood? There is no double taxation. Either the firm pay tax or the partner pay tax. If the firm has paid tax, if the amount is disallowed in the hands of the firm, such disallowed amount shall not be taxed in the hands of partner. The partner shall be liable to pay tax of salary of interest only of the amount which has been allowed a deduction in the hands of the firm. Okay. Now, recently, TDS has also been made applicable on the firm in respect of any payment made by it to its partner. The TDS rate is 10%. It's applicable on an amount exceeding 20,000 at the time of payment or credit, whichever is available. So what it says, section 194 RI. Firm is responsible to deduct tax at 10% on any sum in the nature of salary, remuneration, commission, bonus, or interest paying to his partner. The reduction of tax has to be made at the time of credit or at the time of payment, whichever is earlier, similar to other TDS provisions. No deduction of tax shall be made where such sum or aggregate of such sum does not exceed 20,000 during the financial year. So no TDS up to 20,000. If the amount exceeds 20,000, only then the TDS is applicable at the rate of 10%. Tax has to be deducted at time of payment or credit, whichever is earlier. Okay. Now, important part. This we have already studied in PGBP. Now, assessment of a firm. So, firm is assessed as such. As such means firm is assessed as a firm when if there's a partnership deed or any other document which confirm and shows certifies that there's a partnership, and the share of partners, the share of profit in share of the partner in the profit is determined. So it says, section 184 says, a firm is assessed as such if there exists a partnership deed and share of partner specified in such partnership deed. Okay. And the firm shall continue to be assessed as such for every subsequent year if there is no change in constitution of the firm. So if these three partners, they are agreed to a specified percentage of profit and there's a partnership deed which states this percentage of profit, then any income of the firm shall be taxable in the hand of the firm as a partnership firm. Okay. And it shall continue to be taxed as a firm for all subsequent years unless there is a change in constitution. With changing constitution, we will discuss in a minute. This is section 187. But the assessee, the firm is required to enclose the partnership deed in the first year. So a certified copy of partnership deed shall be submitted along with return of income for the first year in which the firm is assessed as such. So in this first year, it will attach its partnership deed along with its return of income. And if there is any change in constitution subsequent year, then in the year in which there is a change, the change in constitution shall also be attached. Okay. So if there is no change, then you're not required to attach partnership firm every year. You will attach only in the first year. But if there is a change in constitution, you will attach the constitution, change in constitution in the year in which this change happened. Okay. Now, what do you mean by changing constitution? So, what do you mean? Don't look at the notes, just think. Changing constitution means some partners are going, some are coming. But there is some partner which was there earlier also and now also. If there's a firm of A, B, C, three partners, all the three have resigned and D, E, F has joined. This is not a changing constitution of the firm. This is the succession of the firm. The ABC has sold their firm to DEF. Changing constitution means there is A, B, C. Now there is A, B, D. The C has gone, D has come. Or there is A, B, C. Earlier they were entitled to say 30, 40%. Now they are entitled to say 20, and 60%. Okay. So they change in profit sharing ratio. Your partner MSA. In these two cases, where they change in partner, but there is some person who was partner earlier also and after change also, there's a change in constitution, or they're changing, no change in the partners, but they're changing profit sharing ratio. They're changing constitution. But if all the partners have changed, then this is a succession, not a change. You see what it says? It says, where the time of making a assessment, it is found that change has occurred in the constitution of the firm. The assessment shall be made on the reconstituted firm, the firm as constituted at time of making assessment. Okay. Now, what is changing constitution? If one or more of the partners ceases to be a partner, or one or more of the new partner admitted, okay, there is A, B, C. C has resigned, changing constitution. A, B, C. E has come, changing constitution. A, B, C. Now it becomes A, B, D, changing constitution. New partner, even either the existing partner has ceased to be a partner, or the new partner has joined. In such circumstances, that one or more of the person who were partner of the firm before the change continue as a partner after the change. Okay. So there should be some common person who was there before and after. If all have changed, then it's not a change in constitution. Where all the partner continue with a change in respective share or in share of some of them. So there is no change in the partner as such, but they change in profit sharing ratio. It's also called change in constitution. Okay. And if there is a change in constitution, we come to a notice of AO at the time of making assessment, then he will make the assessment on the firm as constituted as on the date of, as on such date of making assessment. This is said by section 187. 188, succession, which we discussed, ABC to DEF. Where firm carrying on business or profession is succeeded by another firm. Understood? And the case is not covered by section 187. It's not a change in constitution. It's a succession. Separate assessment. There's a two assessee. So say separate assessment has to be made on the predecessor firm and successor firm in accordance with section 170. So it's a succession as per section 170, and there has to be two assessment up to a date of succession on the predecessor, from the date of assessment to the successor. Okay. So we discussed section 184, that a firm shall be assessable as firm if there is a partnership deed and it's the deed specified the profit sharing. Then we discussed 187, what's happened in the case of changing constitution. The assessment is made on the reconstituted firm. What do you mean by changing constitution? That either one or more of the partners ceases, or one or more joins, or, but in both these cases, there is some common partner which was there before and after the change, and or they change in the profit sharing ratio of the existing partners. But in case of succession, there are two different type of assessment. One, there are two assessment, one on predecessor up to a date of succession and another on successor from the date of succession. Now liability. Every person who was partner of a firm during a previous year for which the tax liability has arisen shall be jointly and severally liable along with the firm for the amount of tax or other sum payable by the firm for such previous year. Other sum means penalty, etc. So if there is assessment for any year, every person who was partner during such year shall be jointly and severally liable for the amount demand computed in such assessment. Okay, on the firm. And such partner along with the firm. However, if there is a dissolution of a firm, where business or profession carried on by the firm has been discontinued, or where there is a firm is dissolved, the AO shall make an assessment of total income of the firm as if no such continuous dissolution has taken place. And important part, every person who was at the time of such discontinuous or dissolution a partner in the firm shall be jointly and severally liable for the amount of tax, penalty, or the sum paid. So the firm is dissolved or the business has been discontinued, then every person who was there as a partner on the date of the dissolution shall be liable for the demand arisen on the firm. Okay. Now two very small. In case of changing constitution of the firm, so either the partner resign, new partner admit, or they changing profit sharing. So you understand the meaning of changing constitution now? In case of changing constitution of the firm shall not be entitled to have carried forward and set out so much of the loss proportionate to the share of the retired or deceased partner as exceeds his share of profit, if any, in the firm in respect of previous year. So if there is a loss to the firm, such loss is carried forward by the firm only, not by the partner. So one thing is clear, the assessee has to be same. So who has incurred the loss shall carry forward the loss. Generally, the general principle is this. Okay. So if there is a change in constitution of the firm, the loss of the firm shall be carried forward by the firm only. But it says if there is a change in constitution, then the loss attributable to the share of retiring partner shall not be allowed to be carried forward by the firm. This is as per section 78. Okay. This we all discuss about the partnership firm. What about LLP? So under Income Tax Act, partnership firm includes LLP. So whatever we discuss about the partnership firm is equally applicable to the LLP. The only difference is a firm is eligible for 44AD, presumptive scheme of taxation in case of business, eligible business, 6% or 8%. Such 44AD is not applicable to LLP per se. Otherwise, all the provisions which are there for firm are equally applicable to LLP as well. So what we discussed? We discussed the AMT. It's applicable on every person except the company. It's applicable if that such person has claimed a deduction under Part C of Chapter 6A, except ATP, or 10AA or 35AD. Okay. But if you are individual HUF or AOP or BIO artificial judicial person, then AMT is applicable if your adjusted total income exceeds rupees 20 lakh. AMT is applicable only for old regime. If you're opting for new regime, then the AMT is not applicable. The rate of AMT is 18.5%. However, for cooperative society, it is 15%. And for a unit in IFSC, driving income in converted foreign exchange, it is 9%. Okay. If you how you compute adjusted total income? You start with the total income as per normal provision, and you add the deduction. Which deduction? Part C of Chapter 6A, sub ATP, or deduction 10AA, or deduction 35AD. But in case of 35AD, you will add deduction and reduce the amount of depreciation which would have been allowed to you had you not claimed the Section 35AD deduction. Okay. Then comes AMT credit, similar to MAT. It is allowed. What is the credit? The AMT in excess of the normal tax. The difference is the AMT credit, which is carried forward for 15 assessment years. Okay. It is allowed in the year in which normal tax payable exceeds the AMT. Difference only. So, in a nutshell, you have to pay the AMT in every year. It is allowed in the year, even in the year in which the AMT is not paid. Okay. This was all about the AMT. Now, the firm. So, firstly, any interest payable by the firm to its partner shall be allowed only to the extent of 12%. Secondly, salary payable to the non-working partner is not allowed. Thirdly, salary payable to the working partner shall be allowed to the following limit, aggregated. This is aggregate salary to all the partners. For first 6 lakh of book profit in case of loss, the limit is 3 lakh or 90% of the book profit. And on the balance of book profit, the limit is 60%. Okay. What do you mean by book profit is not the same as book profit you studied for MAT? Book profit means the income under PGBP. Add only, you have to add the remuneration debited to P&L account on account of payable to the partners. Okay. Then remuneration interest is allowed only if it is authorized by the partnership deed and it relates to the period subsequent to the partnership deed. Okay. It's not allowed if Section 144 is invoked or you have not complied with condition of Section 184. Okay. Then taxability of partner. The share of profit in the firm is exempt in the hands of partner. Salary interest sector shall be taxable under PGBP only to the extent to which it is allowed in the hands of the firm. No double taxation. Okay. Firm is required to deduct TDS at 10% on any amount of salary, interest, remuneration, etc. payable to the partner. Deduction has to be made at time of credit or payment, whichever is earlier. No deduction if the amount paid or aggregate to the amount paid does not exceed rupees 20,000. The threshold is 20,000. Now, Section 184 says that a firm shall be assessed as a firm only if there is a partnership deed which states the profit sharing ratio. Okay. Such deed is to be attached with the return of income in the first year. And if there is a change in constitution, the revised constitution deed shall be attached in the year of change. Okay. If there is change in constitution which comes to a notice of the AO at the time of making assessment, then the assessment has to be made on the reconstituted firm. What do you mean by change in constitution? If any partner resigns or any new partner comes, while there is some common partner which was there before and after the change, or no partner resigned, no partner come, but they change an existing profit sharing ratio of the existing parties. Okay. Succession. If there's succession, not a change in constitution, then two assessments have to be made, one on the predecessor firm up to the date of succession and another on the succession firm from the date of succession. Now, liability of a partner. Any person who was a partner during the previous year for which there is a liability on the firm, he shall be jointly and severally liable for such liability along with other partners and the firm. In case there is a discontinuance of the business or profession or dissolution of the firm, then every person who was a partner on such date of dissolution or discontinuance shall be jointly and severally liable for the liability of the firm. Okay. Firm is not eligible to carry forward the loss attributable to the share of the retiring partner. And LLP and firm are assessed in a similar way, except under section 44 AD, which is applicable to the firm, partnership firm, but not to the LLP. Okay. So these are all the provisions. Now we will do some questions, so that you understand this concept, how this is applied. A and B enter into a partnership agreement on April 1, 2025. As per the deed, each of them will be entitled to a salary of rupees 2,000 per month apart from the profit. Good. Okay, tell me, is it required that the salary should be paid every month? Answer is no. You can pay the salary at the end of the year for the entire year. So come back to this question. They've entered into a partnership deed on 1st April 2025, and the deeds allows them a salary of 2,000 per month in addition to the profit. On 1st August 2025, they executed a supplementary deed by which they increased the remuneration to 3,000 each. Good. Effective from 1st April 2025. So this is problem. You increase it, no problem, but you increase it from retrospective effect. To do that, but I will not allow the increased amount from the retrospective effect. Discuss the validity. So for income tax purpose, I'll allow the salary 2,000 per month from 1st April 25 to 31st July 25, even though you have agreed for 3,000. And I'll allow 3,000, but prospectively from 1st August 25. Understood? So it says remuneration will be payable effectively from the date of the deed which provides for payment of such remuneration. In the given case, the original deed provides for remuneration at the rate of rupees 2,000 for each partner from April 1, 2025 onwards. The supplementary deed executed on August 1, 2025, increasing the limit of remuneration. Such an increased limit of remuneration will be allowable only from the date of the supplementary date, that is 1st August 2025. And for the period from 1st April to 31st July, the partner will be allowed remuneration only to the extent of 2,000. And this is also subject to the limit of section 40B. Okay? Easy? Messrs. HIG, a firm consisting of 3 partners, namely H, I, and G, carried on the business of purchase and sale of television sets. So there's a question. Sir, if the firm still pays 3,000 for the full year, will 1,000 per month be taxable in the hands of assessee? So he is asking, the Umang sir is asking for in respect of the salary which has not been allowed to the firm, whether such amount is taxable in the hands of partner. Answer is no. If this 1,000 from 1st April 25 to 31st July 25 for 4 months, April, May, June, July, this 1,000 not allowed in the hands of the firm, it shall not be taxable in the hands of the partner, even though the partner has received 3,000 for the entire year, but he will be paying tax only on 2,000 for 4 months and 3,000 for 8 months. Okay? So no double taxation. The law is very clear. Partner is subject to tax only on the amount which is allowed a deduction to the firm. If the firm has any amount has been disallowed in the hands of the firm, such amount shall not be taxable in the hands of the partner. come back to the question. So the firm can still pay. Taxation will be changed. That's it. Right, sir? See, I didn't get the question. What I'm saying is that if the firm has paid tax, then the partner is not required to pay tax on such amount. Okay. So if firm has paid tax on this 1,000 rupees for the 4 month, which was not allowed by the partnership date, it has been allowed retrospectively. On this 4,000 rupees, this 4,000 shall not be added to the income of the partner. Okay. So there's a firm HIG, which has three partners, HING. They are carrying on the business of purchase and sale of television sets in wholesale and manufacture and sale of pens under a deed of partnership, executed on 1st April 2014. Okay. HIG were partner in their individual capacity. Okay. Of course, if not written, I would have assumed it they are partner in the individual capacity only, unless written otherwise. The deed of partnership provided for payment of salary amounted to 1,25,000 each to H and G, who were the working partners. Okay. So there's a deed since 1 April 2014, and that deed provides for payment of salary of 1,25,000 each to H and G, and both H and G are working partners. A new deed of partnership was executed on 1st October 2025, which, apart from providing for payment of salary to the two working partners as mentioned in the deed of partnership, for the first time providing for payment of simple interest at the 12% per annum on the balances standing to credit of capital account of the partner. Okay. So, what's the facts? There's a deed effective from 1st July 2014, which provides for payment of salary of 1,25,000. Okay. Each of H and G. Okay. Who are working partners. Now, they have entered into a supplementary deed on 1st October, and such deed for the first time provide for payment of simple interest. It continues with the salary payment of 1,25,000 to H and G, but in addition, it says that now interest shall also be paid at 12% on the balance tender of credit of capital account from 1st April 25. So now a point clicks in your mind that the deed was signed, supplementary deed was signed on 1st October, but it provides for payment of interest from 1st April. So interest from 1st April to 1st October shall not be allowed. Okay. And such interest shall not be taxable in the firm also. As you asked, Umang, so whatever the interest from 1st April to 1st October shall not be allowed to the firm, and such interest, though received by partner, shall not be taxable in the hands of partner. The firm was dissolved on 31st March 2026. Okay. And the capital asset of the firm was distributed among the partner on 20th 4 2026. The dissolution happened on the last day of the previous year, 31st March 26, and whatever the asset was there, it was distributed to the partner on 20th April. The net profit of the firm for the year 31st March 2026, after payment of salary to the working partner and debit or credit of the following item to the P&L account was 3,50,000. So 3,50,000 profit after payment of the salary. And after debit and credit of these following amounts. What are the amounts? Interest amounting to rupees 1 lakh paid to partner on balance standing to the credit of their capital account from 1st April to 31st March. See, they have paid interest of 1 lakh from 1st April to 31st March. But I will allow interest only from 1st October. So April, May, June, July, August, September. I will not allow the 6-month interest. I will only allow the later 6-month interest. So I allow only 50% of this interest in the hands of the partnership firm. Interest amount to 50,000 paid to the partner on the balance stand to the credit of their current account from 1st April 2025 to 31st March 26. Okay. The firm has paid 1 lakh as an interest on capital account and 50,000 as interest on current account for the entire year. In both cases, the interest paid for the entire year. with effect from 1st April 2025. Interest amounting to 20,000 paid to the Hindu undivided family of partner H at the rate of 18%. So this interest 20,000 is paid to the HUF of H, not to the H, at the rate of 18%. But since who is the partner? Is the HUF of H is partner or my H is partner? The H is partner. The limit of for section 40B is 12% is applicable on the interest payable to H in his individual capacity because he is partner in his individual capacity. Okay. So an interest payable to H in his representative capacity is not subject to section 40B. So even though interest is paid at the rate of 18%, no disallowance because it's not paid to the partner. Payment of 25,000 towards purchase of television sets made by cross check on 1/11/2025 shall be disallowed under section 40 capital A3 more than 10,000. Okay. Rupees 30,000 being the value of gold jewelry received as a gift from a manufacturer for achieving sale target. So this is a perquisite in the course of carrying on business, taxable section 28, and has already been credited. So no adjustment. Depreciation amounting to rupees 15,000 as per income tax rule on motor car bought and used exclusively for business purpose, but registered in the name of partner H. What it's saying? There is a motor car which is used by the partnership firm, but the registered owner is not the firm, it's the partner. So question is whether the firm is eligible for depreciation. So if you know, in the depreciation, we see the beneficial owner. So even if the registered owner is H, but the beneficial owner being the firm is eligible for depreciation. Again, no adjustment. They have debited 15,000, they should have debited 15,000. The fact that the motor car is in the name of a partner doesn't disqualify a firm to claim the depreciation. Depreciation under section 32(1)(2) amounted to rupees 37,500 of new machinery bought and installed for manufacturing of pen on 1/11/2025 at a cost of 5 lakh. So they have debited the normal depreciation 37,500, but the firm is also engaged in manufacturing of pen and therefore is eligible for additional depreciation at the rate of 20% on the new machinery bought. So you understand, the question is hinting that you give a additional depreciation. Additional depreciation is eligible at the rate of 20%, but if the asset is used for less than 180 days, then that additional depreciation is allowed only for 10%, and the remaining 10% allowed in the subsequent year. Here the asset is purchased on 1st November 2025. So it has been used for less than 20 days. So additional depreciation at the rate of 10% shall only be allowed, not the 20%. And the remaining 10% shall be allowed in the next year. Interest amount to 25,000 is received from a bank on fixed deposit made out of surplus fund. So this interest is credited to the P&L account, but it's an income under the head other sources. That will reduce from PGBP and included in the other sources. The firm furnishes the following information relating to it. Closing stock in trade was valued at 60,000 as per the method of lower of cost or net realizable value, consistently followed by it. The net realizable value of the closing stock was 65,000. Okay. So the firm has valued the stock on lower of cost or NRV, and the NRV was 65,000. We'll see what we do. If you remember, there's an ICDS which says that the stock shall be valued at 65,000 only. There's a brought for business loss from assessment year 25-26 of 50,000. And the fair market value of the capital asset on 20th April 26 was 20 lakh and the cost of the acquisition was 15 lakh. This is given for section 9B because there are dissolution and there's a distribution of asset on dissolution of a firm. What is the requirement? I am required to compute total income of the firm. That's it. I am required to compute total income. AMT is of course not applicable. Why? Because there is no such special deduction, neither part C of chapter 6A, nor 10AA, or nor 35A. How will compute total income? I start with 3,50,000. Now see, out of this 1 lakh of interest, I can only allow 50,000 because this is for the entire 1 year. I allow only for the 6 months. So I will disallow 50,000. Why? Because the interest has been authorized from 1st October with effect from 1st April retrospectively. And I will not allow the retrospective interest. I will only allow the prospective interest. So the interest I will allow is only 50,000. I'll add back 50,000 towards interest on capital account. Now, secondly, it says interest on current account. But if you say the partnership deed allows authorize the interest only on the capital accounts of the partner. So interest on current account is not even authorized. Forget about the prospective effect. So this entire 50,000 has to be added by why? Because it is not authorized. Can you understand? The earlier, first point number 1, 50,000 added because it relates to the period prior to the partnership date. And the another 50,000, point number 2, is added because it is not authorized by the partnership date. So Umang, for you, even though the partners have received interest of 1,50,000, but they will be taxed only in respect of 50,000. This, the 50,000 which is actually allowed to the firm. Out of the 1,50,000, I have disallowed 1 lakh. So only 50,000 shall be taxable in the hands of the firm, the amount of which the firm has been allowed a deduction. Okay. Got it. Chalo, thank you, man. No adjustment on account of this 20,000 because even though it's exceed to a 12% rate, but it's not paid to the partner. This 25,000 shall be added by because it exceeds 10,000 not paid by banking channel. No adjustment on account of 30,000. Why? Because it should be included in the income. It is already included in the income. No adjustment in respect of 15,000 as well for depreciation because the fact that the registered owner is a partner does not make a difference. Does not disqualify the firm to claim depreciation. For point number 7, I'll be allowed additional 10% depreciation of 50,000. 5 lakh into 10%. And this 25,000 rupees shall be taxable under the head other sources. The closing stock shall be increased by 5,000 rupees. This 50,000 business loss shall be allowed a deduction set off from the business income. And this is for section 9B, not for the computing the total income for previous year 25-26. And one more point, whatever income I got under that PGBP, I'll add 2,50,000 towards the remuneration and compute the remuneration which is actually allowable under section 40B. So let's see the answer. Let's start with 3,50,000, the profit as a P&L account. You understand? I add 50,000 because of interest on capital account because it relates to the period prior to the deed. I again add 50,000 because it is on interest on current account because it is not authorized by the deed. And then this 25,000 is added because it is paid by otherwise and banking channel. 5,000 adjustment is made towards closing stock. And I add 2,50,000 salary to the partner and I will deduct as per the limit of section 40B. Once I add to compute the book profit under that PGBP, then I will reduce also. I reduce the additional depreciation 50,000. This all we discussed. Then I will reduce 25,000 as an interest because it's taxable under that other sources. I need to compute PGBP. This is the 6,55,000 is a PGBP. From this, I have to reduce the salary allowable and I'll arrive at the PGBP. So from this 6,55,000, I'll apply the section 40B limit where it says on first 6 lakh, 3 lakh or 90% of the book profit. So 90% of 6 lakh is 5,40,000, whichever is more. And on the balance 55,000, 60%, 33,000. So maximum remuneration allowable in section 40B is 5,73,000. But I have paid only 2,50,000. So entire 2,50,000 shall be allowed. Reduce. So my PGBP is 4,05,000. From this, I will reduce the business loss of 50,000. This 50,000 has not been reduced for computing book profit because book profit is the income under that PGBP. Had it been another depreciation, I will have reduced it before computing the book profit. But this set-off is not under that PGBP, therefore I have not reduced it while computing the book profit for the purpose section 40B. Clear? This is my PGBP 3,55,000. 25,000 is the other source income. My total income is 3,80,000. Total income of the partnership firm. Okay? These all are explanation which we just discussed. Now, last question. Vijay Agency, a partnership firm constituted by 3 partners with equal share, was dissolved on 1st March 2025. After such, so there is a partnership firm which was dissolved on 1st March 25. After such happened to such firm. The tax liability of the firm outstanding to be paid was determined at rupees 15 lakh. Okay. So there is a liability, tax liability in the hands of the firm of 15 lakh, which is still payable. Out of the 3 partners, one was declared insolvent on 18 March 26. Okay. This 15 lakh can be recovered from the firm or any of the partner who was a partner on the date of dissolution. This is the section says. So whoever was a partner on the date of dissolution is jointly and severally liable for the liability of the firm, tax liability of the firm. So this for this 15 lakh, all the 3 partners who were there on the date of dissolution shall be liable. But out of these 3 partners, one partner became insolvent on 18th March. The AO for recovering the demand attached the bank account of other 2 partners and could recover an amount of 6 lakh from the account of one such partner. So what the AO did, assessing officer, he attached the bank account of the other 2 partners, the 2 solvent partner, and he could recover 6 lakh from the one partner. Okay. You are asked the following question by the partner of the dissolved firm about the liability of each of them to pay outstanding amount. See, the word jointly and severally means they are jointly liable of 15 lakh. They are individually also liable of 15 lakh. If the other 2 cannot pay, the assessing officer is within his right to recover the entire 15 lakh from one partner. Okay. So all of them are liable up to the date of 18th March 2026, when the third partner was declared insolvent. Up to such date, all 3 was liable. And since the one partner is declared insolvent on 18th March, subsequent to 18th March, the 2 other partners who are still solvent are liable. Whether the action of AO to attach bank account of partner to recover the tax demand of dissolved firm is justified is absolutely justified because all the partner who was partner on the day of dissolution are jointly and severally liable for the liability of the partnership firm. Okay. So this completes my topic, taxation of a company and taxation of a firm. In the next class, we'll complete the other small topic of taxation of individual, HUF, AOP, a sector, corporate society, local authority, small topic, and we'll complete this shortly. Okay. Any query from the today's session? The purpose of today's session was that you revise this concept, and if there's any gap in understanding, you get the understanding as well. So there is a comment. So will we get access to these questions and the notes? Yes, these notes and the question will be uploaded on the portal and you will be able to download. Okay. So thank you, sir. Thank you, Manji. So let's conclude our session for today, and we'll meet in the next class. Okay. Thank you. Done, sir.